Hello and welcome to India Market Open right here on NDTV Profit in an all-male star cast today. Gentlemen, good having both of you. Thank you so much for being on the show today. Yeah. But, enough of women dominance on this show. I've been suffering over the last 7 months.
I don't know if it's a welcome change or no, but it's a change. Well, I reckon that's at least someone will have to put up with all three of us at this point.
No. You're being unkind to yourself, Agam. So, people love watching that FNOPs. About time that they see what you talk about on a full show as well. So I'm just glad that this is happening because I'm outnumbered every single day. This is just such a welcome change.
Right. Yeah, I'm not sure how many times this has happened or I've seen this on screen. So. Lucky to be part of a first.
If you will. But it's an interesting day because we'll talk about multiple things, right? There's a Middle Eastern situation out there. Yeah. The inflation data in India has looked very, very constructive. And the pattern of trade yesterday, I will talk about global, I know, but just the pattern of trade yesterday seemed very solid. So lots of things to talk about today, Agam. But why don't we start with the global piece?
Tepid global cues, not much to talk about because I guess everyone's waiting for that US inflation number to come through. Yesterday was a day where, we had marginal moves. The Nasdaq was marginally higher. The Dow Jones and the S&P 500 were more or less flat. Based on that, we aren't seeing too much in terms of Asia this morning either. And what we are keeping an eye on, as I suggested, that it's going to be all about the inflation data, right? Because that'll give you a better idea about how Fed could potentially go about their own interest rate trajectory. As far as treasury yields are concerned, they actually trended lower yesterday when it comes to the US 10-year. That came in at around 3.9%. Crude continues to trend higher, in fact, and that could be perhaps something that could move not just various factors in the economy, but also in the near term, potentially the dollar, the kind of implication it could have, because that has edged up higher as well. And, all in all, as I've suggested, say for something like the Nikkei, which did move up by around 2.5%, or rather has been advancing by around 2% at the moment right now, we're looking at marginal cues. So not too much to speak for, and the all-important inflation number is what we're all keeping an eye on. Going into today, Niraj. But how are things looking when it comes to India?
Yeah, just a moment on that inflation piece as well, because it's just so important. So Agam highlighted this inflation data, right? Now what's happened there, and both of you can feel free to come in, but here's my small take, and I'm just adding it up with the Nomura piece as well. But the CPI inflation for India moderated below expectations to 3.5% YOY in July from 5.1% in June. Yes, due to a favorable base effect. But, the downward bias offset the higher momentum in food prices and higher telecom tariffs. In fact, if you just look at all the components, the price pressures remained low for almost all categories, but for telecom, which added a little bit of its might because of their raised tariffs. Now, what brokerages are saying, and I was looking at the Nomura note, for example, right? You can look at HSBC, you can JP Morgan, Nomura, or what have you. But the Nomura note says that according to them, the high frequency data points to lower food prices alongside a favorable base in the coming month, and therefore they believe the headline inflation will moderate to 3.2% in August. And for the quarter, which is July, August, September, they expect CPI inflation to average 3.8% in quarter 3. Now, this is great news, guys. We know that it's going to go up again in quarter 3. Yeah. But the RBI, in its wisdom, at the start of the year, had said that quarter 2 will see a moderate inflation. Yeah. It was getting thwarted because of higher food prices. Now, we see that. And because the RBI is so anchored to CPI, even if this doesn't bring out rate action, I don't know how you guys think about it, but I thought this keeps the October policy alive.
Right.
Everybody is saying that October is out of the window even if the Fed cuts.
Sure.
To my mind, this keeps the October policy alive.
Sure. Yeah.
It would, Niraj, but if I were to just argue against that, RBI would want to see not just one quarter, maybe 2 quarters of more stability on an already low expectation. This number, of course, will come as a big positive. But likely they may try to play a little more cautious, a little more wait and watch, because that's likely what the Fed is also expected to do. And a lot of it will depend.
If the Fed cuts in September, then
it's game on likely, because they might follow or they might wait, try to be a little more cautious if that were to be the case. If the Fed were to cut, the chances of a cut by the RBI may also inch up, is the way I would look at it.
But there's only an indirect relation between the Fed and in terms of doing what they want with interest rates and in India. There is no direct relation, and the RBI governor has already said that we're just going to follow our own cues, right?
Yeah.
No, so we've seen at various points in the past, Agam, that even though the RBI governor does say that there is no correlation, there is quite a bit of correlation in that sense. So so there is it adds some weight, is what I would say, to the decision, if not completely.
Just two events put together, a Fed cut and maybe in order to maintain the current rate differential or otherwise for the currency factors or what have you, right? Could the RBI then say that, okay, this has happened plus inflation is lower, can I just do a token cut or change of stance or what have you? But could the October policy be alive and kicking? I mean, to my mind, I don't know. Maybe it just keeps it alive. But now let's see. It's upon the judgment of the MPC. Remember, it's a new MPC that will determine that. So it could be interesting. But anyway, very quickly, before we move to stocks, just a quick thought on the trade setup as well in the session today. So somehow the pattern of trade seems to suggest that the trade is biased towards upticks unless the global sentiment sours. And I think everybody's keeping one eye out on the Middle Eastern situation, and lots of messages, by the way, yesterday, which floated around an imminent strike, but which could be contained and not really spread into regional pieces. Now, lots of news flow out there, depending on which agency you follow and which agency you want to believe, if you will. But one eye out on geopolitics. For geopolitical reasons, flows reasons, as well as crude. I mean, we're not getting that impacted by flows, by the way, because the flows aren't quite there in our favor on the global side. So that's one more thing. And very likely that aside of oil PSUs, and remember ONGC Oil India had the gas price decision yesterday as well, but so aside of oil PSUs and all upstream, PSU banks could be interesting. Harsh might have more insights there, but PSU banks could be interesting. So that is one. And guys, the other piece, sorry, just before maybe Agam talks about the derivative piece or Harsh talks about PSU banks, just one small thing, which I saw yesterday, that one, the pattern of trade that we recovered quite a bit of lost ground. And the delivery-based buying in the Adani Group stocks was really strong. Nearly 2,000 crores marked for delivery in the Adani Group stocks, and you had Adani Enterprises about 3 times the monthly averages, Adani Green quite a bit uptick on the monthly averages as well. Adani Power delivery volume was 650 crores, which was 2.4 times the monthly average. Adani Ports was 1.8 times the monthly average. Those numbers on your screen. So quite a bit of delivery-based buying that you saw in the Adani Group stocks. And standard disclaimer, of course, that the Adani Group owns NDTV and you're watching NDTV Profits. So I want to leave that out there. But fact is a fact that there was a delivery-based buying of 2,000 crores in the Adani Group yesterday.
Right. Well, I just want to very quickly also address what's happening with respect to fund flows. So yesterday was another day of trade where we actually did see substantial outflows from the FPI standpoint. On a net basis, we in fact saw an outgo of around a little less than 4,700 crores. From the domestic institutions, however, there was buying worth a little less than 4,500 crores. What stands out for FPIs is that out of the last 7 sessions, we've seen an outflow in the last 6. On the other hand, DIs have come through and they have bought in all of the last 7 sessions. So that, of course, stands out when it comes to FPI flows, institutional flows in general. And well, domestic institutions continue to support that selling and absorb the selling that's coming from FPIs. So that's as far as fund flows are concerned. But Harsh, MSCI changes, how do things stack up here?
Well, so MSCI overall has made several changes, Agam, but I want to first off address the largest of the pack in terms of changes. We have something like an HDFC Bank where MSCI has made a largest change. First off, to try and understand or get perspective on what has happened up until now. You've had foreign headroom in HDFC Bank exceeding the 25% mark, which means that ideally HDFC Bank allowed 74% foreign ownership and HDFC Bank has less than 49% foreign ownership currently. And that leaves quite a bit of value on the table when it comes to upgrades from the MSCI. Now, mind you, in any case, HDFC Bank is a huge heavyweight on the MSCI. And therefore, they had given it an adjustment factor, which determines weight basically of 0.5 when the merger had happened. This has now gone up to 0.75. So therefore, weightage of HDFC Bank likely to go up. What they are suggesting seems to be very interesting, because going forward, they're going to increase it to 1. Now, as the adjustment factor gets revised to 1, likely the weightage will also go up, and that will happen only and only if the foreign headroom remains 25%. That is, foreign ownership remains less than 49% in HDFC Bank. The timeline for this given by MSCI is November, and therefore if that were to happen, at least a 49% plus a 49% minus kind of foreign ownership would definitely leave HDFC Bank with an adjustment factor of 1 and increase its weightage. On top of this, what MSCI seems to be suggesting, they're comfortable if foreign headroom even shrinks to 20%. So from the 25% currently, they are willing to let it go to 20 by November, even if that were to happen. So even if foreign investors were to pump in another 5% by HDFC Bank to the tune of 5%, they will likely increase the weightage to 1, and the weightage would likely go up in the MSCI. So monitor that foreign room within the MSCI. Outside of that, several changes made. Let's pull some names, some stocks up. RVNL, Zydus Life, Vodafone Idea, Oil India, Oracle Financial, some of the inclusions that have come through, on the MSCI, at least on the global front. I'll also try and pull out some more names. PB Fintech is one of them, outside of all of these, where MSCI has revised or rather included it as part of part of their index. That's part of the August rejig, which is expected to happen by 2nd of September. Outside of that, there have been 8 additions and no deletions to the August review in the MSCI Domestic Standard Index. The additions include, again, RVNL, Zydus Life, Vodafone Idea, Bosch, Oil India, Phoenix Mills, Dixon Tech, and PB Fintech. These are some of the other inclusions. Within the small cap index, 27 additions and 6 deletions. Top additions being Bandhan and GoDigit. Dixon has been upgraded to mid-cap status from small cap, and Ireda and Cochin Shipyard and HUDCO. These are 3 of the 6 deletions that have happened. The weight in the small cap index has shrunk by 20 basis points, 0.2% to 28.8%. The overall weightage of the MSCI Emerging Markets Index has gone up by 40 basis points for India to 19.8%. For China, it's come down by 50 basis points to 24.2%. India now at all-time highs. And last off, with regard to the India Domestic Small Cap Index, 25 additions, 8 deletions, GoDigit being the top addition to the index. RVNL, Phoenix Mills, Dixon Tech removed because they've been upgraded. Ireda and Cochin Shipyard removed altogether.
So just very quick 30 seconds on HDFC Bank.
Yes.
What's the difference? Because you're expected to, like FTSE did it, to be done in 4 tranches. Instead of that, it's happening in 2 tranches.
It's happening in 2 tranches. Currently, the weightage to go up from 0.5 to 0.75. Likely in November. Unlikely that foreign headroom would go up by so drastically from 49 to 54 plus. And therefore, that adjustment factor will adjust itself to 1 from 0.75.
So bunched up flows effectively, slightly more positive.
Correct, slightly more positive.
Okay, okay. The other piece, viewers, and since we are on MSCI, so before I hand it over to Agam for his set of stocks, just marking the MSCI piece, the embargo on Adani Group stocks reviews has been lifted by MSCI. So they will factor in fresh developments, will mull fundraise and liquidity factors as well as a part of this, and the recent fundraise of Adani Energy to be considered. Why this? So just laying out again with all the standard disclaimers that when the Adani Energy QIP happened, and this would happen for any company in which there is an uptick out here, but when the Adani Energy QIP happened, the weightage didn't go up because there was an embargo on the weightages of the group stocks. Now that it's been removed from the future reviews, when the developments happen which prompt MSCI under a normal course to make an adjustment on any stock, and if an Adani Group stock would qualify, then they would do that. So just wanted to lay it out. It could be construed as a small positive for Adani Energy Solutions today itself, by the way, but let's wait and watch. I'm not betting on that as much, but the fact remains that this, from the next reviews, could be something that people will keep a keen eye out for. So that's the other piece to monitor.
Right, then we move on and start taking a look at all the stocks which will be in focus today, and right at the top, of course, there'll be Vodafone Idea. This one is actually seen a lot of strength return over the last 6 months to 12 months, and we actually have earnings. This time around, the quarter looks a little bit more mixed. Remember, the previous quarter, we did have a lot of strength return to the earnings of the company. Since then, we've had the company also raise and hike its tariffs. As far as this particular quarter is concerned, sequentially, we're looking at a decline of around 1% in terms of the revenue. And its margins largely at around 40% against 40.9%, so not much change there. And there has, however, been a net loss which has narrowed to 6,400 odd crores versus around 7,600 crores. Among the other highlights, so naturally we will be keeping an eye on ARPUs, or average revenue per user, which has been largely flat sequentially, but it has also moved up 4.5% on a year-on-year basis, also on expected lines to about 146 rupees. In terms of management commentary, we are keeping an eye on the shutdown of 3G sites in 7 circles, which could potentially hamper, well, some part of the earnings going forward. But it doesn't seem like a very, very big thing as far as Vodafone Idea is concerned. It is in process of shutting down 3G across other cities as well at the moment, and expects the data capacity to grow by 15% by September 2024. Moving on to Hindustan Copper, it does seem like it's a very strong quarter coming through. 33% growth in revenue, substantial expansion in EBITDA margins, in fact standing at around 38.3% against 25% year on year. Remember, pricing of commodities has a huge role to play, and it clearly has played in favor of Hindustan Copper. Consequently, net profit has risen 140% year on year. Next up, we also have Senco Gold, which has in fact expanded its showroom portfolio to 165. And among other highlights that has been mentioned here, we are looking at these showrooms, and with a same-store sales growth around 4%, and of course, among many others that we are also keeping an eye on, average selling price, or rather average ticket price, coming in at around 13% growth when it comes to year-on-year basis at around 49,000. So several of these factors playing out in favor of Senco as well, and something that we would like to keep an eye on. Harsh.
Right. Let me first start off with Happiest Minds, Agam. We're seeing numbers. Let me first mark them out. 11% growth on the top line, 464 crore versus the 466 crore estimated. That's largely in line. But where's the miss? EBIT is down 8.1% on a sequential basis. It's at 63 crore in terms of EBIT versus the estimated 84 crore number. Margins, therefore, at 13.5% versus the expected 18% margins. This is the lowest margin Happiest Minds has ever clocked, and therefore this stock will definitely be in focus. Net profit is down 29% to the 51 crore mark, all numbers QOQ, versus the 75 crore number expected by analysts on Bloomberg. And therefore this one likely a very, very large miss. Keep your eye out on this one, likely to move. The other one is DOMS. Very strong numbers. I'll move from 1 weak to 1 strong. And DOMS Industries, very, very strong numbers overall. Revenue coming in at 445 crore. You have a margin number which has come in at 19%. And, let me just pull out the number in terms of growth. We've seen very strong growth from DOMS. Coming in as well. 17% growth. And therefore, this one will definitely likely be in focus. Let's pull up a third one, NMDC. This one, again, very strong numbers overall. I'm looking at a top line growth of roughly 0.5%, but versus Bloomberg estimates, the number has held up. So it's on a higher base where the number has held up. You're seeing EBITDA up 17.5% versus the 2090 crore EBITDA number expected. The EBITDA has come in at 2340 crores, so 17% uptick. Margins at 43%, highest margin number since December of 2021. Mind you, that was a positive cycle, and NMDC margins really doing well this time around as well. Net profit up nearly 20% at 1971 crore versus the 1726 crore, versus the 1652 crore numbers same time last year. So again, a 19% growth coming in there. Bloomberg estimates at 1726 crore. Very, very strong numbers from NMDC as well as DOMS, but poor numbers from Happiest Minds.
I'm going to take a leaf and continue with two metal stocks, but you know what surprised me is Harsh did not speak about PSU banks or life insurance.
Yeah, I was
thinking inflation numbers, PSU
Yeah.
banks will be top of Harsh's mind, or life insurance. Maybe we'll do it in round 2.
Yes, we'll do that.
Yeah, the life insurance in particular, because HDFC Life has been killing it really in a good way. But I'll take two metal names as well. Hindustan Copper, decent numbers. I was speaking to Mihika before I came in for the show. Revenues were up 33% YOY. Let's get the Hindustan. We have the numbers as well relative to estimates too, but sales were up very strongly. It is the EBITDA margins which was very, very strong. EBITDA margin came in at maybe 38% or thereabouts versus 25%. So Hindustan Copper EBITDA up 103% at 189 crores versus 93 crores. Margins looked strong too. Like I said, 38.25 versus 25.06, up about 1,000. You know, the reason why I say 1319 bips is 1319 basis points. So from 25 to 38 is a 1,300 point uptake. You know, viewers should educate what this means as well. So good to lay it out. But remember, it's at 20 versus 25%. 38%, and therefore the bottom line numbers look very strong too. The only point is, Mihika was saying that the guidance is a bit tempered, or the belief is a bit tempered about Q2, also because prices have come off, etc. So great numbers, maybe not as great an outlook. Let's see if it's a bit tempered. Nalco though had no such problems and very strong numbers, and considering what Hindalco might do, Nalco might be a specific one that you want to watch out for, because that too could do really well for itself. So do watch out for all of these three metal names in particular. I thought AMI Organics left a bit to be desired. So we're talking about chemical names. I don't know if either of you picked AMI, but if you haven't, I'd just like to dwell on that a little bit. Revenues were up 14.9% at 177 crores versus 154 crores. So lower than estimated revenues. Better than guidance, lower than estimated. The point is margin performance, 16.7 versus estimated 17.4. PAT down 34% at 14 crores versus 22 crores. The estimates were 22 crores. So relative to estimates, a very weak set of numbers, so very likely could react. And Olectra Green Tech, while the revenue numbers were looking very strong, the EBITDA margin performance, 13.7 versus 19.4, and net profit therefore not up as much as the revenue numbers. So bit of a weak performance for a stock that is extremely expensive. I think it trades at about 70 times or thereabouts TTMP. So not a very cheap stock, not delivering on margins, very likely could see a bit of a negative reaction. So do watch out for this one as well.
Right. Before I go to Harsh for Hardco and IRFC, because those stocks have also had a great last 12 months, I'm going to pick up on a handful of relatively smaller names as well. DCX Systems, again, this is a very weak quarter here. We're looking at a revenue decline of around 19%, and we're looking at an EBITDA loss of 5 crores against a gain of around 8 crores. And Olectra Green Tech. Now, while there's been a lot which has been spoken about when it comes to Olectra Green Tech, we've seen a 45% growth on a year-on-year basis. However, margins have tempered considerably, coming in at around 13.4% against 19.4%, and hence net profit has fallen, or rather net profit has risen to by 33%, but your operating profit has fallen quite substantially. Of course, there will be certain one-offs which will play against, or rather in favor of the bottom line of Olectra Green Tech, but save for that, it's been an operationally weak quarter. But Harsh, coming to you on Hardco and RIFC.
Yeah, let me start off with IRFC. The numbers don't look standout, Agam, to be frank. We've seen very strong returns for this stock, for this counter. The numbers seem a little more tempered versus that. So we're starting to see that margins have started to come under a bit of pressure. We've seen net interest income, which is largely flat on a year-on-year basis, just slight increase in terms of total income. And interest expense has gone up quite significantly. Let me mark that out for you. The interest expense has gone from roughly 5,091 crore in Q1 FY24. It had shrunk to 4,725 crore in Q4 FY24, has gone back up sharply from 4,700 crore to 5,155 crore. So your interest expense has started to expand. Total income largely looks flat on a year-on-year basis. And that's where likely the concern will come from. In terms of provisioning, no concerns at all. Impairment is actually negative, so there are still reversals in the pipeline which are coming through, and has been the case for both Q1 FY24 as well as Q4 FY24 as well. You're also seeing overall profitability continuing to hold up quite well on a year-on-year basis, but not really significantly expanding. So from that 1551 crore number in Q1 FY24, the number has come in at 1577 crore. So no expansion per se in ROAs or in profitability. So that's one. Let's quickly pull out HUDCO if we can. Well, revenue at 2,188 crore. Your interest expenses have again risen quite sharply from 1,300 crore to 1,460 crore, and therefore you're seeing a likely contraction in margins. Mind you, they don't bring out margins, but likely contraction in margins this quarter. And what you're also seeing is on a year-on-year basis, profit not expanding as much from the 519 crore number in or rather 446 crore number, quite a solid expansion, I beg your pardon, from 446 crore in Q1 FY24. The number has come in at 558 crore in Q1 FY25. So solid expansion in terms of profitability. Again, last off, I want to try and cover PSU banks. In case of a rate cut, likely beneficiaries will be PSU banks. Deposit growth has been under pressure. They've been in single-digit deposit growth, most of them. And with a rate cut, likely that deposit growth momentum should start to pick up. Some amount of competition in the deposit space should start to ebb if at all a rate cut cycle were to start. So likely one of the first beneficiaries could be PSU banks. I want to also quickly mark out one of the few sectors is the PSU bank where there has been a 15% correction from the top. So if we can pull out the PSU banking index from the top of 8,000 plus, we are now sitting at 6,900 odd. And therefore, that correction has been significant from the top. So 15% correction. Keep your eye out on these stocks. If at all, the RBI would cut rates, one of the first movers likely would be the PSU banking counters.
In fact, I don't know if the inflation numbers today bring about some excitement in yields and thereby PSU banks in the session today as well. So that's the other interesting piece to my mind. But since Harsh has left it to me to talk about life insurance data, I'll just look at the Citi note. And the Citi note says that HDFC Life is outpacing across parameters, and it's another strong month for them. They are, of course, overweight on HDFC Life, with saying HDFC Life and SBI Life remain their top ideas. So watch out for HDFC Life, particularly in the session today. The note says that HDFC Life is sprinting ahead with individual APE growth at 58% in the month of July, significantly higher than the industry average of private peers at 30%. So that's one name to watch out for. I'll also watch out for the two new kids on the block today and some strong listing, I would reckon, expected for Unicommerce because of the kind of subscription that happened to and the kind of excitement for that stock. So first scribe 12 times, okay, but Unicommerce is interesting one. So that plus a lot of brokerage notes which we'll highlight during the course of the session. But this is the first round, viewers. Thanks so much for being with this very elongated part of trade setup, but today was just that kind of a day. And we need to slip into a break. We need to show the implied open. We haven't quite done that. So let's just mark the implied open and show what the implied open is suggesting today, a flattish start anticipated. But before we take that break, or as we head into that break, hear out some expert opinion on the failed Hindenburg hit job. Veteran banker KK Mistry says that the report is based on meaningless interpretations and correlations. Listen in.
Well, personally, if you ask me, I think the report is based on a lot of meaningless interpretation and correlation of totally unrelated items. I mean, for example, the clarifications which have been issued by the SEBI chairperson and her husband clearly state that they had invested in the offshore fund at a time when they were private individuals. And they had no connection whatsoever with SEBI. Also, they were living overseas and they had made sufficient disclosure to SEBI at the time of joining SEBI. Now, as a private individual, I or any individual can invest in any fund that they want. And at the time of investing, you're not going to go into who the other investors in the fund are. It's completely irrelevant. It's not even possible, and it is irrelevant.
Welcome back. This is India Market Open. We are now going to look at the futures and options space. Well, yesterday was a day of trade where we started off with some amount of weakness. Eventually, we saw the Nifty cover a lot of ground and closing only marginally in the red. Let's take a look at how things have fared as far as futures are concerned. Now, we eventually didn't see too much change when it comes to the open interest for the Nifty August futures. The Bank Nifty or futures, on the other hand, are looking at further unwinding to the tune of nearly 3%, even as the index advanced marginally. But when it comes to the options cues, for now, Well, it was a range-bound sort of day yesterday, so we continue to see more traction on the call side of things on the higher end, watching out for 24,400, 24,500 calls, seeing a little bit more writing, and on the lower end, we saw further strengthening of open interest around the 24,000 strike put as well. Well, moving on, it was a mixed day of trade yesterday. We had one gainer for one loser in the broader markets in terms of the advanced decline ratio. We had names like Sun TV, Nalco, and Astral, which were under pressure, so we did see shorts there. Longs in case of Voltas, which is clearly the stock of the day yesterday on account of earnings, and Coromandel International also advancing by 2.5%, looking at longs among stocks which saw unwinding. Short covering for Siemens, Granules, Axis Bank, and SAIL. Long unwinding for Syngene International. But there's lots that's happened over the last few days, and even in terms of stocks, there's plenty of churn. How do we go about these indices? How do we go about the stocks specifically in the derivative space? Well, let's get in an expert opinion here. We have Amit Goel of Amit Ventures joining us on the show. Amit, good morning. Thanks for joining in. Let's start with your view on the Bank Nifty. I believe you have an option structure here. What is your view, and how are you using options to deal with your analysis here?
Hi, good morning, Agam, and thank you for having me here. Good morning to all your viewers. We've been discussing Bank Nifty's movements over the last few times that we have met, and I did happen to have a contra view last time, if you remember, and I was trying to play for the upside a little bit. That seems to have played out, and viewers, if they had taken the trade, would be in profits today. I continue to maintain my bullish stance, although a little cautious on it, because we are taking support at higher time frame support levels and trying to move up a little bit. But every up move is also met with fair amount of selling on the tops, and hence we are creating what we would call technically dojis on the daily candles with slight upward bias. So the kind of trade that I would want to play here is I would want to play for a fairly non-directional to upward bias kind of a trade with next week's expiry. What we are looking to do here is we will set up an iron butterfly, which is essentially a non-directional trade. The time we would want to enter this is when the spot is trading between 50,500 and 50,700, in which we will sell the 50,700 21st of August expiry, call and put one lot each, which is essentially a short straddle. But since we understand that the short straddle is a unlimited risk sort of a trade, we will also buy the wings with the 49,700 put and the 51,700 call. The max loss is a defined trade here at 4,500 with the max profit at the peak, which is the pin level of 50,700. It gives us 10,500, though we will aim for about 5,000 rupees profit, making it a 1:1 sort of a trade. The logic, as I've explained, I'm moderately bullish on the price action. And if you look at the open option chain also, 50,000 and 51,000 seems to be the near-term support and resistance levels, with market moving fairly in the middle of it. So that's the view on Bank Nifty, Agam.
So I just want to reiterate this particular option structure. What Amit is suggesting is that you wait for the Bank Nifty to move, sustain about 50,500 and 50,700 thereabout, and that's where you in fact go ahead and sell that particular strangle, or that's 50,700 strangle, and by that I mean sell the call and the put of 50,700, and to make sure that things don't go awry very quickly, you also buy the wings. And in this case, you're buying the 49,700 put and the 51,700 call. While the maximum profit stands at around 10,500, Amit is also suggesting that you look to perhaps book your gains if you actually do see a gain of around 5,000, 6,000 rupees per lot. And of course, the loss number at the moment is also suggested to be around 4,500 rupees per share. Amit, just a follow-up question for this option structure. I would assume that if you actually go ahead and deploy this option structure even at this moment, I'd reckon that you would get a slightly favorable a risk to reward ratio because it is not at the money. Would you agree, and how would you go about that if you were to take something like that?
Perfectly. I completely agree with you, Agam, on this. The reason that I am playing for 50,700 butterfly is, as I told you, that I am slightly bullish on the directional aspect of Bank Nifty. Hence, I am trying to play for that slight up move on the direction, which gives me a better yield in terms of RR. So yes, I agree with you on that point.
All right, fair enough. Let's talk about the oil and gas space, Amit. We've seen a lot of strength yesterday in names like Oil India, and ONGC as well did advance. Of course, a lot of that was for fundamental reasons. But what are your observations technically, and what are you doing with it?
Yeah, so as we have discussed, the broad indices, they are not really moving too much. There's, I would say, from a technical standpoint, there is a lack of momentum there. But there are pockets in the broader market which in which we are witnessing a fair bit of momentum on both the upside and downside. I'm trying to play for pure momentum over here with ONGC. The chart structure looks good. We are closing at all-time highs with strong volume. So there is a lot of buying interest. There is a lot of continued buying interest in this counter. Fundamental reasons and the positive news flow also help matter. Hence, I would like to play for a bullish setup, given that the IV levels, the implied volatility levels, are slightly elevated for ONGC. What we would like to do is we would like to play for a credit bullish spread, which is known as a bull put spread, in which we will sell the 340 put of August expiry, and we will buy the hedge of 335 again of August expiry. The maximum debit in this trade is going to be about 4,500 to 5,000 rupees, and the max profit also is likely to be around 4,500 to 5,000 rupees. Given that the risk reward is going to be about 1:1. The stop loss here in this trade is going to be a close on a daily basis below the 20 moving average, 20 period DMA, which is 325. The time I would want to enter this trade is when the spot is trading between 340 and 342. The trade logic is very simple: strong price action, uptrending stock. It's trading above all important moving averages, and the OI data also suggests long build-up in this counter.
Right, Amit, I just want to confirm that this is a credit spread, right? So it will lead to a credit of 5,000?
Yes, that's right.
Okay. So, well, I think our graphics team should change that word from debit to credit. But moving on, I believe you also have AU Small Finance Bank in focus. Amit, can you take us through that one?
Yeah, again, I'm playing for momentum in the stocks because I'm trying to capture the trend in these counters. Like ONGC is uptrending. AU Bank, unfortunately, is on a downtrending spiral, and it has made a top of 700 and has continued to give lower lows and lower highs on the daily time frame. So what I'm trying to do here is I'm trying to play for the downside, simply because the logic is weak price action. It's a downtrending stock trading below all important moving averages, including the very important and crucial 200 DMA. The OI data also suggests a lot of short built up that is happening in this counter. So I'm trying to play for the downside on this counter. Given that the implied volatility levels, which is an important metric for an options trader, is slightly on the lower levels, in the sense it is slightly depressed, I'll try to play for a debit spread here and try to play for the momentum on the downside, as well as try and capture any increase in implied volatility. The trade here is suggested to be a bear put spread, which is a bearish trade. We will enter this trade when the spot is trading between 610 and 609. We will buy the 610 put of August expiry and sell the 600 put of August expiry. Here again, the debit, max debit on this trade, or the max loss, is going to be about 4,000 rupees, and the max profit is likely to be about 5,500 to 6,000 rupees, giving again a risk reward of 1:1. The stop loss over here is also going to be similar to ONGC, a daily close above the 20 DMA, which is at 641 levels. Thanks.
All right, Amit, we leave it at that. Thank you so much for joining us and taking us through your views on the markets and giving us the three option structures to work around with on all those securities that you have on your radar. Thanks so much. But with that, it's over to you, Harsh.
Right. Thanks for that, Agam, for taking us through all of that. Let me quickly go across. We have Yogesh Patil of Dolat Capital with us to talk to us about ONGC. Now, Yogesh, let me just quickly come to the point. Couple of developments with regard to ONGC, positive ones, of course. 20% premium price for domestic gas for new wells. How constructively do you look at this, and when does the impact start to feel, at least where the numbers are concerned?
Okay, thanks. So, lot of series of positive news flows for the ONGC in last couple of days. First one was a 20% higher gas prices compared to the APM gas prices. So now looking into the ONGC, ONGC will produce close to 21 BCM kind of a gas in FY25, and additionally 20% incremental gas will come from the newer field like the KGD6 Western Offshore fields. These additional incremental gas will be eligible for the 20% higher gas prices compared to the APM. That's the positive. If we look down into the EBITDA side and the EPS side impact, these 20% higher gas production will lead to close to 7 to 8% EPS upside. On the top of that, again, a 20% premium gas prices will again lead it to the closer to 7 to 8% EPS upside. So in total, 15% EPS upside would be there. That is the one thing. But in last few years, what we have observed, ONGC's gas production is on a decline, mainly because of a natural decline. The fields are old. So it will take a time to ramp up the gas production from the newer field also. So not exactly into the FY26, but in FY27, 28, we can see a 25 BCM kind of a gas will come from the ONGC fields. Approximately 20 to 25% of these total 25 BCM gas will be eligible for the 20% higher gas prices. So I think so. This is one thing. And recently, if you notice down in the Friday evening, ONGC come out with the one press release that the government has approved sanctions for approved the amount closer to 18,000 crore. So this is approval from the side of a government to the ONGC. ONGC can invest the same amount into the one of their subsidiary, that is the ONGC Petro Additions Limited. That subsidiary was suffering from 2 to 3 issues. Like one issue was their higher debt. So the debt was quite closer to 32,000 crore. And because of these fund infusion from the side of ONGC to the OPAL, will bring down 32,000 crore debt to the closer to 19,000 crore. That's 11 to 12,000 crore. That is the one thing. Secondly, ONGC was also, OPAL was also facing an issue of a shortage of gas from the domestic fields. So government has notified in that press release that ONGC's OPAL will start receiving closer to 3.5 MMSCMD kind of gas for the petrochemical unit, which is the OPAL. So all these two things are positive, and the stock has also reacted positive to this news flow and the developments.
Got it. Yogesh, one quick follow-up. There are two key triggers here, of course. The other key trigger is going to be the production ramp-up at KG Basin, likely from Q3 FY25. Do you believe that continues to stand? That's the first part of my question. Second is, when do the EPS upgrades, which you've just spoken about, start to kick in, at least where your numbers are concerned? FY27, FY28?
So coming back to your production upside question, yes, Q3, not Q3, but in a Q4 FY25, we will see an uptick in gas production from the KG basins, what the company has guided on the recent call. Secondly, increase in EPS we can see in FY26 majority, because not only from the gas production upside in KG basins, but closer to 45,000 barrels per day additional oil will also flow from the KG basin. So gas plus oil will drive up our FY26 numbers, and that will be really visible in FY26 side.
Well, the stock has had a great run, Yogesh. Just with regard to year-to-date return, 66%. And over the last 5 days also, we've had a very good run, almost 8% higher in the last 5 days alone. Valuations, do they continue to look attractive to you?
So what we believe that stock is not still factoring or discounting at $75 per barrel net realization on their oil side. Secondly, in last 2 to 3 years, what we have seen number of policy changes which are in favor of ONGC. Earlier the gas prices used to in the range of $3 to $4 per MMBTU. Now they are realizing closer to 6.5. In FY26, that gas price realization will again go up by $0.25 per MMBTU. So all these positive things are not completely factored in. We still believe there is a upside still remain in the stock, and we are positive with the accumulated rating on the stock.
Yogesh, is there a big differential in terms of financial performance between ONGC and Oil India, or do you expect Oil India to move in tandem?
So, in case of Oil India's gas production upside is also there. But the problem, not a problem, but the issues with the Oil India is that the gas which they can produce even right now, that is a strand. They need the northeast gas grid pipeline ready that should get connected to India gas grid pipeline. Then only Oil India can evacuate or can transmit the gas from the northern eastern side to the main part of the India. So we need to wait and watch till the time these gas pipelines get ready. Then only that gas pipeline can transmit the gas from the Oil India fields to the main region of India. That's the one thing. Secondly, Oil India is not at all facing any kind of oil production decline. So they are not facing a natural decline as of now. And they are consistently reporting the positive oil production growth in last 2 to 3 years. So that is a positive thing compared to the ONGC, at least in the current scenario for the Oil India.
Very quickly, 30 seconds. I don't know if you track some of the smaller ones, but some of the others which have started coming out with their gas blocks, HOEC and some others. Do you track any aside of ONGC and Oil India?
We only track ONGC and Oil India.
Got it. Okay, great. Yogesh, thanks so much for joining in today. Really appreciate your time this morning. Well, that's the view from Daulat Capital. And remember, a clutch of other brokerages too. There is Citi, there is Jefferies. All of them have sounded optimistic on this announcement. And you saw some bit of an uptick in those stocks yesterday. Can there be more? Let's ask our experts, Rajat Bose. He joins in right now on the technicals of the markets at large, and on the fundamentals, Sunny Agarwal, Head of Fundamental Equity Research at SBI Cap Securities. Gentlemen, both of you, thanks for joining in. Rajat, may I ask you, since we were talking about the oil upstream names, let's start off with that. What's your view on ONGC and Oil India, or maybe some of the others that you may track like HOEC? Is there a trade here?
ONGC, definitely there is a trade, because immediately I'm expecting that it will test the Bollinger Band high posted recently around say 350. That's the indicator high. And it can actually move to that level. And once that is taken out, then ONGC can move further up. 370 to about 373 would be the immediate target. But ONGC, after say a consolidation of 3 or 4 months, it has started moving up from July, and it is still moving up. It has consolidated again between 320 and 40, and today I'm expecting a breakout. So ONGC is the prime one. Apart from that, you said Oil India. Yes, Oil India definitely is another stock to track, because if you look at from a technical point of view, Oil India looks better. Oil India shot up to 640, 650 kind of levels earlier in July. And after that, there was a correction to 560 or even lower. And then it has shot up again and currently at 667. Immediate target for today, it would be 675. And once 675 is decisively taken out, then 689 to about 693 would be the short-term target. Anybody taking a position now would have to put a stop loss anywhere around 640.
Okay, so we have a comprehensive view on ONGC and Oil India, not only from a fundamental perspective, but also a technical one. And with that, we shift focus to two of the government NBFCs which came out with earnings, that is HUDCO and IRFC. And for that, let's get in Sunny Agarwal of SBI Caps, who's also joining us on the show. Sunny, morning. Thanks for joining in. IRFC and HUDCO and any other government-oriented NBFC that stands out for you. How have things shaped up, and how are you looking at these?
Yeah, good morning everyone and thanks for having me on the show. I think among the government NBFCs, I think HUDCO has reported a decent set of numbers. We have seen a significant uptick in sanction as well as disbursement during the June quarter. And at the same time, there is a lot of tailwind in terms of spending on infrastructure as well as affordable housing as a segment. So I think HUDCO has reported a very good set of number, in fact, for the June quarter. Coming to IRFC, again, there it's a more of a kind of flattish number where we have seen not a very significant jump in whether it is the net interest income or profitability. At the same time, IRFC, I find valuations to be very expensive, trading north of a 4-time price to book. So I think, but anyway, it's a play on railway financing as a story. So I think maybe a kind of neutral reaction we can see in the trade today. And for somebody who's a long-term investor can look at the stock on maybe on a deep when the valuation turns comfortable. So these are the two set of numbers as far as NBFCs are concerned. In addition to that, I think many metal mining companies have also reported number yesterday among the government pack. Do you want me to discuss that or we will take it later?
Yeah, we can actually talk about that, Sunny. Go ahead. Tell us about what you made of the metals and the mining companies too.
Yeah, so basically NMDC again a decent set of number, but if you look internal number, so there is there is a correction in the sales volume and pricing. However, the increase in profitability is purely due to the reduction in the royalty rate. But we have already seen a correction in the NMDC as a stock, and at current market price, the valuations look attractive. And we believe the fair value of the business is close to 280 to 90 rupees. So NMDC, decent set of number backed by the lower royalty expenses. Nalco has reported a very good set of number, a pretty robust set of number by Nalco. Again, led by cost optimization, good realization, at the same time, good demand environment. So Nalco, I believe, thumbs up to the Nalco. And Hindustan Copper, again, a very good set of number from Hindustan Copper, led by a very good realization. However, of late, we have seen a correction in the copper prices. So the impact of the same will be seen in the September quarter in terms of a dip in realization. So Hindustan Copper, again, in case there is a correction in the Hindustan Copper over the next month or so, can be added in a long-term portfolio.
Okay, German, stay on. We'll take a break. Rajat Bose's recommendations still pending. We'll do that after this very quick break. Stay tuned.
Welcome back. Thanks for tuning into India Market Open. We have both our analysts with us. Rajat, let me come straight to you with regard to your top picks for the day. What's on your list?
A couple of stocks. First is an engineering R&D software company, that is KPIT Tech. It is said to be, it is regarded by even some FIIs to be the best of the lot. And it has given a new and a fresh buy. The situation is very good. This buy call, I would give that immediately you put a stop loss below, say, 1765, and your upside would be something like 1877 and 1909. These are the two targets that I have. But if any person is willing to hold it for the longer term, that is also pretty good. That outlook is also very good, because the monthly chart suggests that there would be significant upswing going forward over the longer term. The other stock is Concor. Concor, it is in case of Concor, what I would say is that it is very close to its 200-day exponential moving average, which is around 942. Concor is likely to go up from here, and I would put a stop loss below 939, and my targets are 1030 and 1055. 1020 to 1030 would bring in some supplies, especially for the short-term traders. But 1055, once crossed, Concor actually could do very well. And it's also a very good long-term stock in my view.
Got it. Okay. So two both near-term and medium-term ideas from Rajat, and from sectors which are not necessarily the talk of town. Thanks for that, Rajat. Well, it's a delight to have in Ashish Somaya, CEO of White Oak Capital AMC, just for the perspective of the texture of the Indian market in light of the fact that we seem to have become a low beta market, and it was evident in the way we recovered from what was perceived to be a potential market mover, which is that Hindenburg note, and just the way we shrugged that off completely. Ashish, good morning and thank you for joining in. Niraj here. What do you make of the way the market shrugged this off? Because there were telltale memories of what happened in Jan and Feb 2023, but it was not even remotely close to anything that happened then.
Yeah, Niraj, thanks for having me. I think probably, last year's experience showed to the market that, maybe there is not much substance. I think it caused a flutter last year, and then the way things moved after that, clearly, whether there is any substance to it, how much to read into it, what is the lasting impact. I think all of those things the market has, a few lessons learned, number one. And number two, I think what came this time around seemed, like a serious stretch of imagination kind of situation. So I think, people have kind of maturely taken it in their stride. And, hence, market has, kind of not really paid much attention to it.
Sure, Ashish. Harsh also joining in. Ashish, I'll shift focus. We're at the fag end of Q1 FY25 numbers. What's really stood out for you as part of Q1 earnings, and do you believe that earnings is, quickly living up to the kind of valuations that we've actually built on even prior to Q1?
So see, I think that a lot to read in the way the market is behaving. A lot to read into the way the market is behaving. The reason I'm saying that is because you can clearly see some kind of rotation setting in, and market is taking cues probably from the earnings itself. So if you see some of the sectors, right, we've seen this, 2006, 7 and 8, we all were around and we saw what happens when market runs purely on order books. So there are some sectors, where it's all been led by order books, and even if all those order books fructify and all of those result in free cash flow and all of those free cash flows are in excess of cost of capital, even then, how much does the valuation really justify? So I think some of the sectors have been running purely on sentiment and order book and investment-related announcements, etc. And on the other hand, there are some sectors where the earnings have consistently played out, but on the other hand, they are, on a relative basis, they have been underperforming. So if you really ask me the story on earnings, and at the same time, the way the market has been reacting, under the surface, you can clearly see that there is a rotation which is kind of setting in. And everything that had a rip-roaring rally in the last 2 years seems to be kind of, I think, is set to cool off. And everything which has been underperforming in the last couple of years, purely on relative valuations, I think market is set to rotate. The second important thing is that when macros change, the drivers for the market also kind of changes. If you see from N21 till a couple of months back, the dominant narrative was, higher for longer and interest rates. And interest rates were the biggest headwind, and hence, short cycle businesses with short cycle cash flows, they kind of outperformed. I think now the narrative is that at least for the US, Europe we have seen, and at least for the US, appears that rates will tend to go down, which means that businesses with long cycle cash flows would tend to, bounce back or outperform. So our results, last couple of months of market behavior and some of these macro trends, everything kind of points out to a rotation. And you can clearly see it in performances as well. So I think that is something that everybody needs to prepare for.
Okay. Ashish, appreciate you joining us for this quick perspective, texture of the market, earnings and more. Really appreciate. Thanks so much.
Thank you. Thank you.
That's the view from Ashish Somaya. The market certainly shrugged it off. And while the volatility you could argue is sustained, but it was a lot less volatile than otherwise anticipated. Okay. Now, in terms of numbers, and just before we get to a brokerage call for the day, Sunny, some of you spoke about the metal names. Yes, I was looking at the footwear names, right? Bata, weak numbers came in, disappointed the street. Your peers have a large sell there. Today, campus activewear, or rather yesterday, campus activewear numbers left a bit to be desired. What's happening here? There's this talk of how BI has been implemented from August 1, and that will shift the market from unorganized to organized. But the numbers until now are not quite there. Are you constructive or would you stay away?
No, I think from a medium-term perspective, I would like to stay away because we have been seeing a pain in the entire footwear industry since last 8 quarters. And despite of all the story of shift from unorganized to organized sector and implementation of regulatory changes, still the companies are unable to deliver on the in terms of number, in terms of growth, margins are under pressure. I think this clearly indicates that there is a demand pressure as far as the rural belt is concerned, especially for the footwear industry. And that is leading to a kind of subdued number from the entire footwear space. From a risk-reward perspective, yes, I agree that all the negatives are in the price. But if somebody is looking for a money-making opportunity, I feel still footwear as a space is where we will see a consolidation for a quarter. And maybe a second half, I'm hopeful that demand will pick up and that will lead to the increase in better product mix and better margin expansion and earning growth number. So I think I would like to remain neutral at the current juncture on the entire footwear as an industry.
Okay, that time of the show where we go and focus in on the one stock which is on brokerage radar, rather, one which stands out. Anushi, which one have you picked for today?
Hey Harsh, so for today's pick is Signature Global, again a pick in the real estate space over here. Over here, Motilal Oswal has initiated a buy call with a price target of about 2,000, which is from the current levels, it's about a 38% of an upside that we are looking at. So again, a couple of factors that the note has highlighted. So if you look at the pre-sale CAGR over the course of FY21 to 24%, strong trajectory at a 63% of a CAGR growth that the company has maintained. And going forward to FY24 to 27 period, it expects this pre-sales momentum to continue at a 35% of a rate. Now, the company has a strong launch pipeline in place to support this growth potential that we are looking at. 30 million square feet to be launched in the next 2 years. So that is over there. And if you look at the operating cash flow side also, the company expects to generate over 9,500 crore over these next 2 fiscals, which again will leave ample room for getting more such land bank into picture and support the higher growth potential that we are looking at. Coming to the valuation side, if there was a peer comparison which is to be made, Motilal still believes that Signature Global is on the better side as valuations have not picked up the company's future growth potential as of yet. So the stock has still not priced in that the growth momentum that we are looking at. So again, a price target of 2,000, 38% upside that we should be looking out for Signature Global.
Well, real estate continues to be in focus. Sunny, let me come to you with regard to this one, as well as the larger real estate pack. How are you viewing it? We've seen a slew of upgrades over the last year or so, despite the kind of run-up that we've seen in the stocks. Target prices continue to be revised. Sunny, what's the sense like?
Yeah, I think a very strong set of pre-sales numbers from majority of the real estate player, and that is leading to the earning upgrades by the analyst community. And I think if you look at the entire real estate as a cycle, we are in the mid cycle as we talk to various management. I think everyone is very optimistic in terms of demand environment over the period of next 2 to 3 years. And at the same time, the street is hopeful that with the interest rate cycle topping out, we may see a benefit of a lower interest rate, maybe a 6 to 9 months down the line for the entire residential real estate as a space. At the same time, the commercial real estate, case in point, Phoenix Mill, continue to report a robust set of number, basically reflecting a strong urban consumption story. I think we will continue to see a better set of number as far as real estate as a company is concerned, as a sector is concerned. But what I feel is that a few of my topics over here will be again a Phoenix Mill. The reason being that a very strong set of number, urban consumption story, which is still continue to do well. A few smaller players like Anantraj Industries, where it's a mix of data center plus real estate play. There also we have seen a very good set of number. Century Textile, which is a kind of Birla Group play on real estate, there we have seen a pretty good set of number penetration into a lot of new markets. So these are the few players which we like from a real estate space.
Okay. Well, also want to take stock of Dixon Technologies, because what we've seen is that over the past 6 or 7 odd sessions, we've once again started to see it move up. Of course, it's been a stock not without its fair share of volatility. If I could take this up with Rajat. Rajat, your way forward on Dixon Technologies, what levels would you be keeping an eye on towards long or the short side at the moment?
First of all, if Dixon Technologies were to move up, then it would face strong resistance around, say, 12,700 to about 12,750. Once this zone is taken out, there would be fresh upsurge that is possible. But the pattern is suggesting that there could be an upside provided it manages to stay above 12,000, say that is something like 163 points from the last close. It can do that because it was taking support on a GAN angle, and it was also taking support from the 50-day moving average. So chances are you will see a retest of 12,500 to about 12,050. After it crosses 12,750, we can project further upside, and that would be nothing less than another 1,000 points.
All right. And the other one I wanted to speak to you about, Rajat, was OFSS, that's Oracle Financial Services. The chart is very similar here as well. Levels to keep an eye on here?
Here the levels would be, the recent high around, say, 11,300. If 11,300 is taken out, then OFSS can actually move much further up from the current levels. This is one stock, I suppose, just like Dixon, it can acquire momentum. Currently, it is being resisted by the 20-day exponential moving average, which is around, say, 10,730. Once that is taken out, then 10,800 to about 10,825 would bring in some supplies. But as it crosses the levels of 11,000 to 11,350, there will be again some supplies, but the long-term chart suggests that it can still move further up.
Okay, Rajat, let me stick with you. I want a quick view with regard to HDFC Bank, MSCI inclusion very quickly because we are maybe a minute away from market open.
Well, regarding HDFC Bank, it is likely to move up because it has shown a strong support area around say 1600 levels, and now it is already 1628 in today's market. It is likely to move up, but I would say that unless it crosses 1720 to about 1760 range, no upswing is likely to sustain, because around that level, if I sell very heavily.
Okay, so HDFC Bank. Rajat, sorry if I missed it, but if I haven't, post pre-open rates, if you had to bet on one stock for the day today, we have 20 seconds.
Well, Zomato, 265 now. It can go up to 269, 273 kind of levels. Zomato, the disclosure has it that I personally hold some shares in the company, but I like it technically.
Okay, so viewers, remember a couple of ideas: KPIT and Concord from a slightly medium-term perspective or a swing trade perspective. I think from a day or a short-term trade perspective, top call Zomato from Rajat Bose. Stay on, gentlemen. Both of you will taking opening thoughts from you post-market open. But here's how the markets are starting off this Tuesday morning. Flat as flat can be for the Nifty, 14 odd points, 0.06. Bank Nifty a bit lower. Wonder if IT is giving that little bit of a support to the markets. Maybe actually all the indices are very, very flat. Mid caps and small caps, I wonder if there is a flat move there too. Well, maybe 0.5% higher or nearly 0.5%. Around 1/3% for the mid caps, about 1/3% for the small caps as well. Let's get the heat map up on the screen for the large caps at least and show you what's moving and what's not. HDFC Bank is not seeing a reaction. So was the market positioning or position for the entire flow to come in one tranche, and that not having happened? Is there a bit of a disappointment here? Will that get bought into? I think it'll be interesting. Rajat spoke about HDFC Bank. We'll revisit this, but this is the key reason where the markets are a bit sluggish, because there's more green than red on the screen. Axis Bank up 1%, ICICI Bank up 1%, Kotak Bank up 1%. So thwarting what HDFC Bank is doing, by the way. Apollo Hospitals up about 1% as well. SBI Life out there. I don't quite see HDFC Life though, interestingly, because that presumably had done even better than SBI Life had done. Adani Ports and Adani Enterprises in the green too. So both of them doing okay. A bit of TCS, a bit of Tata Steel, but well, Agam, before I hand it over to you, it seems like it's HDFC Bank, which is the top draw, being thwarted by the other banks in the session.
Well, there's no doubt about that, Niraj. It is essentially HDFC Bank which is weighing down on the indices, and had it not been for that big heavyweight, we would have clearly been in the green for now and prominently. But when it comes to the broader markets, the mid-cap and the small-cap indices, firstly, advancing, outperforming clearly. We have about a 0.3% gain, a 0.4% gain for the mid-cap index, and again, the same for the small-cap index too, 0.3%. So plenty of traction there. The outperformance for the broader market indices continues with respect to the Nifty and the Bank Nifty. Now let's take a look at some of these stocks from the broader markets which potentially could have moved on the back of earnings. So I'm going to take those names which have in fact outperformed the expectations of the market. Vodafone Idea, well, actually, to be honest, it was a mixed quarter. So while we have marginal losses there, it's actually flat. I wouldn't take too much from that red tick as far as Vodafone Idea is concerned. But Hindustan Copper on expected lines up 4%, because that certainly has been a very, very strong quarter. And NMDC also, in line, up as much as 1.3%. But what about stocks which have, well, perhaps, missed estimates? We are keeping an eye on AMI Organics on expected lines, down around 1.3%. But Olectra Greentech, I reckon that the operational performance has been completely sidelined, and market participants are very happy with its top line, which is why Olectra Greentech is up 6%, and Campus Activewear, again, wilting under pressure on the back of, weak numbers coming through, down as much as 3% as well. Next up, we have the MSCI rejig, counters which are in focus. So RVN are clearly up as much as 3%. Zydus Life the inclusion at this point in time perhaps doesn't hold too much. And let's not forget Oil India. But Oil India is not just advancing on the back of the MSCI recheck. There are several other fundamental factors playing in favor of Oil India, which is also the reason behind that up move around 2%. And finally, moving on to stocks. Beyond just earnings and the reject, we have Senco Gold. Remember that they have also added significant amount of number of stores in the quarter gone by. KPI Green Tech, on the other hand, it's down around 2.6%, but that's also because of the QIP coming through, and Man Infra also in focus and buzzing in trade. So all in all, more gainers than losers, and the broader markets continuing to outperform the benchmarks for now.
Right. Let's focus in on a couple of other counters, especially in the energy space. Let's pull out something like a Suzlon up another 4% in trade, at least at the start today, 4.5 now. Let's pull out the Inox Group. Inox Wind up 10. What's Inox Green doing? I think that one is also up 4. Rajat, let me come to you with regard to charts on some of these counters. We're hitting new highs on a daily basis on some of these counters. What's the sense like at this point on charts?
Look, regarding Inox Wind, I would say that Inox Wind it has consolidated for a long period. 3 to 4 months of consolidation. Then this breakout is happening, and yesterday it clocked a very high volume. That means that the kind of movement that you see today was very much anticipated. It is a gap up open, and after that it moved up. Now, I would say 233 needs to be cleared. Once 233 is cleared, then it can move up to something like 245 to 247. The other stock that you talked about, RVNL?
Fixed set of stocks.
Suzlon is on a tear. It is just moving like it is moving in one-way traffic kind of a thing. So Suzlon 85 crossed, 89 would be the next target, and once it crosses 89, we will project further up.
Too, Rajat, but just for a moment, we need to cut across where Anand Mahindra is speaking.
I want to congratulate you, Supam, and your entire team that is here. And I want to express our gratitude for creating value. I want to express my gratitude to you for creating value for yourself and for your entire team. I want to congratulate you and express my gratitude for creating enormous value for Mahindra. And I want to thank you in particular for creating enormous value for this country. Give them all a big round of applause.
Other one which is slated to rev up some feelings is Unicommerce, because just by virtue of the kind of subscription that has had. Okay, what's doing well, interestingly, and 2 or 3 names which stood out for me. Adani Energy Solutions, by the way. Guys, we were talking about it in the morning about how this adjustment would mean that Adani Energy Solutions, which normally would have seen an uptick in MSCI post the QIP, was not able to because of the embargo. Now comes into play, so that stock is up. The one which surprised me, though, is Olectra. Because I was talking to Puneet as well. The numbers and the margins looked wobbly. But Olectra Green Tech is up about 5% in trade. So it's a splendid up move for this 6.5%, for the stock.
Yes, absolutely. Especially given the kind of margin contraction we've seen, that one has done fairly well in trade, at least to start the day off. Let's pull out Signature Global, which was our stock of the day with regard to brokerages. That one is up 3% as well. Among other stocks, I want to also quickly mark out Ingersoll Rand, which is up, again, roughly 4% in trade. Forgings is down around 1% or so. Dollar Industries, 1.5% lower as well. A couple of those taking it on the chin today slightly. But Senco Gold up 5.5%. Again, very strong numbers, good commentary coming through as well. Agam spoke about that one. DOMS Industries up 1.5% as well, along with IRFC and HUDCO. I want to mark both of those 2% higher on both IRFC as well as HUDCO. So some positivity, especially among the stocks in focus. Let's also pull up a couple of other ones. KPI Green is down 3% among the energy pack, and HDFC Bank now down nearly 2.5%. So those two, a bit of a disappointment in terms of those two. Man Infra up around 0.8%, promoter buying around 50,000 shares in trade on the 9th of August.
I just want to take stock of Adani Energy Solutions, because remember that about a week and a half ago, when the QIP did happen, we had the Duquesne family buy into this particular counter, and also Stanley Druckenmiller of all the investors. So you have two very marquee names getting into this, and yesterday it did seem like it was an opportunity to perhaps get into Adani Energy. Today, clearly, the stock is advanced by as much as 5.3%. Of course, a standard disclaimer that this is an Adani Group company. But this particular counter does stand out. And the fact that the embargo has been lifted from the MSCI standpoint when it comes to the Adani Group companies as well is the other factor that, of course, plays out in favor. Very quickly, perhaps we can also take a look at names like BEL. Now, names like BEL and Mazagon Dock and something like a Garden Reach Shipbuilders or Cochin Shipyard have gone into a bout of consolidation. What's the way forward here? Sunny, your view on some of these defense names, would you want to perhaps partake in here because valuations look pretty rich, or would you want to avoid at the moment?
Yeah, I would like to be very selective as far as defense names are concerned, especially among the PSU basket. So I think a bigger size companies like BEL, HAL, where there is actually a very strong visibility for next 3 to 5 years in terms of order book execution. There we find comfort, but again, the expectation has to be toned down looking at the reach valuation. Among the defense play, we would like to ride this sector through a private sector, small size companies like Zen Technologies, where we have seen a very strong uptick in earning growth. At the same time, we continue to remain bullish on the company's prospect on robotics as well as simulator side. So Zen Tech is the one company which we would like to ride as far as defense stories. The Premier Explosive, again, a play on defense as well as the space sector. Their company very similar to Solar Industries, supplying explosive for space and defense stories. So Premier Explosive is another counter. So rather than betting on a large cap company, I think there are many small companies in the private sector which are emerging, which are likely to emerge as the winner over the period of next 2 to 3 years.
Rajat, before we wrap up, RVNL, can't not talk about that. What's your view here?
RVNL did very well yesterday. In fact, it probably would do, may not be a similar kind of fit that was done yesterday, but it is going to move up. It has given a buy signal after a good amount of correction. And now it is 593. I'm expecting if it were to cross, say, 610 and 625. So RVNL definitely looks pretty good that way.
Okay.
But I'm not bullish on defense stocks.
Okay, not bullish on defense in general. RVNL railway stock may do well, but we've got a defense company up next, so it'll be important to understand what the growth numbers look like. Rajat, Sunny, thank you so much, both of you, for joining in today. What we do is, on the note that the indices are lying absolutely flat, with the Bank Nifty down about 1/3%, courtesy HDFC Bank, we slip into a break. We come back and get in Amit Mahajan of Paras Defense to talk about the Q1 earnings and more. Stay tuned.
Welcome back to India Market Open. We are now in conversation with Amit Mahajan, the director at Paras Defence and Space Technologies. Amit, good morning. Thank you for taking the time out. Amit, it's been yet another staggering quarter for you. In fact, for the second straight quarter, we are actually looking at a considerable amount of growth on the top line, which has clearly had its impact on the bottom line as well as the operational numbers as well. Your assessment of what's going on, what is the reason behind the 73% growth in the top line for the quarter gone by? And I'm only making an assumption that this is not the normal growth. Eventually, you will see a little bit of moderation tapering down, even as we see the base effect come to play. But your expectations with respect to this financial year, based on the kind of trends that we've seen in the past 2 quarters?
Firstly, good morning and thank you for having me on this show. I would consider the driving force behind any growth, for that matter, is the amount of opportunities that a particular company has. And we have a very, very solid lineup of funnel and opportunities for the work that we have done in the past. What we're going to get in the future is yet even bigger. But what we have done in the past, we have a very solid lineup. Our opportunity funnel is in excess of thousands of crores. And the order book, which is very strong, at least 2x order book that we enjoy, I think that is one of the reasons why we could deliver what we have been able to deliver. Now, looking at Q1, I'm telling you that the trend will continue at the end of, we are a project-oriented company. We should be looked at on a yearly basis. On a yearly basis, we are looking at about 30% or slightly 30% will also be a little conservative, but in excess of 30% growth.
Okay. So based on that, what are the areas that are in fact playing out for you in your favor, Amit?
The areas, if you see last quarter, I'm talking about the Q4 of last year, optics, there was, because we're getting from component business into a product business, the optronic product that which is a high value one, which got shifted to Q1. This particular product will play out as almost every quarter. And the optics and optronic systems is one extremely scalable business. And at the same time, it is very profitable when it comes to the company and the business. So we would always want to make sure that optics and optronic systems is the vertical that influences our revenue, and that will be our growth strategy moving forward.
Does the optics and optronics segment also provide you the bulk of your operating margins or the expansion in operating margins? If you can classify that for us.
Absolutely correct. So they provide not just the revenues and the scalability, but they also provide the operational margins. They actually go and compensate the competitive business that we do in, say, defense electronics or, mechanical engineering. So they give you the bulk of your profits.
Sure. So Amit, going forward, I know, and we understand that your current order book is at around 630 odd crores. This was the FY24 number that we had. If you can give us an update on your current order book, also the kind of projects that could perhaps be in the pipeline that could, come through going into the next couple of quarters.
So now the order book continues. Yes, we have delivered some, and there is, you can see whatever we have delivered has gone down, but again the order book will start swelling again from Q2. The kind of projects that we are looking at projects coming in from EO/IR systems. We are looking at projects coming in from the space domain because the space sector is again warming up. We would look at defense electronics to continue growing because although we are in a competitive space, the competition is relatively very, very limited. And our defense electronics is like spider. It has gone almost in all the programs we are there. So those programs are getting into higher volumes. So basically you see the percolating effect of defense manufacturing in India, Make in India effect and the Atmanirbhar effect, you will be able to see on the order book. So on the defense electronics side, the EMP, the electromagnetic as a vertical, not just on the pulse side, but electromagnetics as a vertical is also having good amount of opportunities. That particular vertical itself has more than, I would say, 500 to 600 crores worth of funnel in front of us. So if you go and see, all the sub verticals of our company have strong opportunity funnel in front of us.
So, Amit, the question here is that, are you guys going to actively continue to focus on optics and optronics while you get orders passively when it comes to defense engineering as well? Is my understanding there correct? Or are you also looking to perhaps grow in defense engineering? And under those circumstances, what sort of projects are you aiming for when it comes to the defense engineering projects?
So optics and optronic systems, like I'm telling you, there are certain products that are under our belly. These products give us a lot of scalability. Notwithstanding that, it is like your two children, right? You can't choose between one and the other one you let go. So defense engineering vertical, if you see, they have three sub-verticals. One is the mechanical engineering, which is required and rather fueling almost all the other sub-verticals of our company. Then there is electromagnetics. So in electromagnetics, we have a very, very unique positioning. In the country, we are the only company doing electromagnetic pulse protection. Now we're getting into larger projects related to electromagnetic solutions. So that is a position that we would not want to let go. Yes, it is picking up slowly as compared to optics or defense electronics. But it is, when it picks up, it becomes a very, very big sub-vertical in its own domain. Defense electronics. Now, when I'm saying defense electronics, electronics, although it's a competitive market, the opportunities are way, way higher than any other vertical that you can think of. So, although there are competitors, everybody has their own share of business, and the size of opportunity per company, if I have to divide, is very huge. So although we as a businessman, we would want optics and optronics to do good, but I would not play down on all the other sub-verticals of ours, which are our core strength, which are also our unique positioning in some way or another. Apart from that, what I would also want to get to the table is the anti-drone subsidiary of ours. Then there are other subsidiaries that we have started work on. So all these, you have to look at fueling all of these such that they pave the way for your opportunities 2 to 3 years from
now. Scope for the next indigenization list to have that could possibly involve products and services that you are catering to, but they have not been in the list earlier?
There are a lot of technologies currently. And also on the optics side, I am very, very happy to see that there are 5 lists. Every list has contributed to opportunity for a company like Paras Defense. Also, somewhere which used to look like a very sluggish strategy 10 years back, that we have almost all the products that you can think of. We call ourselves as one-stop shop for defense technologies. Used to be a very risky domain 10 years back, but today when you look at every manufacturing that you need to do in India, Paras becomes your obvious choice, because we have had a good heritage of working on those technologies in the past. Now today we have an option of becoming not just self-sufficient for the Indian requirement, but also we can blossom these technologies for being world ready and start exporting them.
Amit, in some sense, the stuff that you're saying, good morning, Niraj here, the markets are rewarding you for that, right? Because as it is rewarding the defense sector at large, but in your case, I'm just saying that the multiples that your stock trades at is a clear vindication of the fact that the market believes in some of the things that you say. And my question is, would the market be right in believing that there is a J-curve growth ahead of you at some point of time in the next 1 to 3 years, whenever you take advantage of all of these factors that you spoke about, the spider-like spread, presence in multiple places, etc.? Does it show in a growth of your top line numbers in a bit of a hockey stick effect at some point of time in the next 2-3 years?
As much as I can tell you that I'm really grateful for the market to bestow so much trust on us, I will tell you, for us, it is business as usual. So what we always do is we don't look at how the market is going to respond to what we are trying to do. What we always ensure is our business growth should be sustainable.
Amit, I was not trying to say that you are following the market. I'm just saying the market trusts you. You're mentioning that you have so much of presence. So I'm telling you that the market trusts you. Now, my point being, the market also believes that you will do that. Is the market right in believing that there'll be a J-curve effect in growth?
The market should believe that the business has to be sustainable. J-curve, if it is in good for the company in the long term, if somebody believes, I have my doubts about it. The company always would look at growth which is sustainable in nature. So I would always keep a curve which is more linear in nature than a J-curve, because linear will ensure your growth and it will be long term. J-curve will someday will hit down as fast as it goes up.
Okay, and just one last question. What's the pace of that linear growth? Let's say, I don't know if you guys think about it that way, but if you do, then what is a 5-year, 7-year CAGR that you have in mind?
So we are looking at 20 to 30% when we say used to look very aggressive a few months or few years back. Today, when I say 20 to 30 is very conservative. And that is we would want to at least have that visibility for the next 3 years. Next 5 years, maybe it will be higher than that, but 20 to 30% is the growth rate you should be looking at from a company like Bharat Steel.
20 to 30% for the next 3 to 5 years, and post that period, the growth could be higher as well. The growth percentages could be higher as well.
Yeah.
With similar or better margins.
Margins will only be better.
Only be better. Okay, great. Amit Mahajan, take a moment to thank you for joining in today and giving us your thoughts. Really appreciate your time this morning.
Thank you so much.
All right, that's Paras Defense for you. And by the way, the markets have flattened out completely. But Agam, something that Varsha will be talking on at this, just before we take that break, just want to do a quick market check. A lot of stocks which are doing well. Aarti Industries.
Yeah.
The stock has collapsed today post the con call commentary.
Yeah.
So that stood out for me.
Niraj, after talking to a handful of participants who always been in and out of Aarti Industries, there has always been this feeling that there is a lot of volatility in Aarti Industries with respect to the kind of business that they take out. It's down as much as 12% at the moment, and that's okay.
It is 12%.
Locked in a lower circuit, I believe, at one point in time, and it's looking at more weakness coming through. It always has the ability to bounce back, but there will be long periods and long bouts of volatility, which may actually lead to a lot of discomfort for long-term investors. But that's just the way the nature of that particular sector is, and you can't rule out the implications, the impact that the pricing environment in this particular sector has when it comes to Aarti Industries specifically. But, let's get a little bit more insight into what's happening here. We have my colleague Varsha who's joining us to give us an update on this one. Varsha.
Well, thanks, Agam, for that. So everything is about company not meeting its guidance. That's said in the con call. They've indicated that they're not going to meet guidance, and they're going to revisit their EBITDA guidance of 1,450 to 1,700 crore due to margin volatility as there's a lot of pressure from China. The company wants to watch margin trends over the next 2 to 3 months before committing to EBITDA guidance for the full financial year. And if you see, their debt could reach to around 3,500 to 3,600 crore because of the capex that they are doing, but they do maintain volume growth of around 20 to 30% in FY25, and they are confident that they'll reach 40 to 50% of capacity utilization within the current financial year. If you see, that discretionary segment, dyes and pigments, continue to recover and can see sequential growth, but the Red Sea issues are still there, and that is impacting their freight costs and impacting global supply chain, which could actually hit volumes in some segments. And they expect 70 to 80% of their products to have competition from China, and China competition is a major pressure on margins, particularly in the agrochemical sector. So basically, not meeting their guidance is one of the reasons that we are seeing pressure on the stock.
Varsha, just one very quick question, Varsha. Agam was talking about how the stock tends to bounce back as well. Was there any positive in the con call at all? Quick 30 seconds.
Yeah, so volume growth, so they have maintained volume growth, which is actually a good thing. 20 to 30% of volume growth they are maintaining, but the street is disappointed because street was actually interested in the EBITDA margin the EBITDA guidance of 1400 to 1700 crores. And this is the reason we saw, RT bouncing back, but now because they are not meeting that guidance, street is not happy with it. But yeah, volume growth they're going to maintain at 20 to 30%. So this was one of the interesting thing in the con call.
And so one more question really, Varsha. So therefore, if they're not meeting that guidance, what is the current valuation then if you have it at the back of your hand? Is it now therefore expensive because they're not meeting 1400 to 1700, therefore the EV EBITDA, is it expensive now?
Yeah, sort of. We could see, more pressure on this stock. So yes, because the street was estimating that 1400 to 1800 crores of EBITDA, and now that we are not getting that EBITDA, so yes, currently yes, expensive because there's still competition from the China, and second quarter may be impacted because of the pressure that we are seeing. But yeah, things will start to improve from H2 FY25. So yes, still I think the valuation is kind of expensive.
Thanks. So we will talk more about this during the course of the day, but we need to slip into a quick break. On the other side, Dynamatic Technologies came out with their numbers. I went to their plant and spoke to Udyant Malhotra, the founder and MD of the company, on the quarter gone by and the outlook ahead. Stay tuned. Thanks for tuning into this very special broadcast. I am at the shop floor of a company that is making the whole or the part of the structure that you would have seen, a Bell helicopter. I've never seen a facility like this. And the man who's painstakingly built this, or if I'm not wrong, 39 years, Udyant Malhotra, with me here at the shop floor of Dynamatic. Udyant, great having you.
Hi, pleasure indeed.
It's been an absolute delight watching what is a very state-of-the-art facility. Just before we get to the nooks and corners, what is this? Can you just tell us?
Okay, this is the fuselage of the Bell 407, which is the world's largest selling helicopter. We make 1,600 parts that go into this, and then we do the assembly of these major structures that form the fuselage of this remarkable helicopter.
Wow. Okay. Yeah. Now, viewers, I want to tell you, as much as it seems to me that I'm in a complete aerospace facility, Dynamatic is a lot more than that. So, Udyant, just tell us a bit about Dynamatic, because as I learn, you're doing three things in your business, right? There is hydraulics for tractors and others. There is metallurgy division, and there is aerospace. Yeah. So tell us a bit about Dynamatic.
So our hydraulic division is the world's largest manufacturer of hydraulic gear pumps, which creates the pressure that you need in a hydraulic system. Our largest market is agricultural tractors, but also construction equipment like bulldozers, drill rigs, cranes, excavators, and even battle tanks. And while we are a very large manufacturer of hydraulic gear pumps, we are now in the next 5 and 10 years increasing our wallet share by making valves and systems for the same customers. Okay. So we intend to move using the market share that we have, which is very large, and increasing our share of the market to grow the business.
Okay.
A share of the wallet.
Got it. Okay.
Yeah. The second business that you talked about is metallurgy. We had 3 foundries, 2 in India, 1 in Germany. We divested of the foundries in India. We've retained the German foundry, which largely caters to the best German automotive industries. But we are now segueing that into aerospace and defense. And that's why we retained that particular facility.
Okay. So
and the third business,
you move out of then the auto piece per se, or do you?
So the Indian foundries were completely automotive, which we divested. We've retained the German foundry, which is a very fine foundry with a great history. And in the next few years, we are segueing its capacity and its capability to making aerospace and defense products right in the heartland of Europe, where there are shortages right now.
So you do auto, aerospace, and defense, all 3 out of that foundry.
Out of that, yeah.
Okay.
Yeah.
And the third, the sexy looking one.
Well, this was actually my childhood passion. I was a hobbyist, and in a little garage behind the hydraulic pump factory in the early 90s, we started making aero structures as a developmental partner, first for DRDO, then HAL. We learned a lot from them. In fact, I'd like to say that I'm a child of HAL, but in the private sector. And we then developed a global footprint, making products for Airbus, Bell, Boeing, Dassault, some of the best companies in the world.
Wow. Okay. So I want to do a broad brush first before I talk about the specifics, Uday. So from the, just give us a sense of, based on either revenue or order book or both, where do each of these 3 divisions stand in your overall setup? And your past shows that you build the business not with a 1 year, 2 year target in mind, but a longer term horizon in mind.
Yeah.
So I'm presuming that's what your view is right now as well. So what is the current and what is your view, say 3 years out, 5 years out, or till the end of the decade for each of these 3?
Okay, so it's really interesting. There are 3 ways to look at time. One is, of course, time in relation to yourself. I was much younger earlier, so I had longer time frames to look at. I'm older now, so I'm obviously closer to the latter part of my career than I was 30 years ago. The second part of it is also harvest. You build a business for 20, 30 years and suddenly opportunities for harvest, for much bigger things come, because these businesses take a lot of time to build.
Okay.
So what we've done is we built a really fine world-class aerospace business where we are a global tier 1 with engineering capability to the best companies in the world. We are the first winner of Airbus's Global Sustainability Award. We are last year's Boeing Supplier of the Year award. These are global awards. And we've been Bell Helicopter's Best Global Supplier. So what you've done is you've created excellence where your customers appreciate the quality of work and rigor of what you do. And therefore, once you have that, you're able to broaden your market. And that's where we are now. So when I say harvest, it doesn't mean harvesting as in, taking more value, but you suddenly have more opportunities than you had earlier.
Mm-hmm.
It takes a long time for a tree to grow, a good tree, and then suddenly you have the harvest, and then you're able to multiply it in a much faster way. And that's where we are now in aerospace.
Okay.
In the metallurgy business, it's really about taking a business that was much larger. We took our automotive business that we built, we divested out of it. We were making engine products, and we obviously saw the electrification of the industry. So we sold the Indian auto parts engine parts business to people who wanted it. We kept the German piece because of the skill sets and took what was a 100 million euro business, shrunk it to half, to 50 million. We've got latent capacity, which we're right now using to build a ground up aerospace and defense business.
Okay.
So that's where we are. Now, if you take the metallurgy business, probably in the next 2-3 years, you'll have a very nice aerospace defense metallurgy business coming out of that. If you take our hydraulics business, as we go from market share to wallet share, you can look at a roughly 500 crore business that should be able to double in the next 5 years and then double again 5 years later. So you're in a nice position where you have a good reputation, you have a good market share, and you just need to increase your share of the wallet. The real interesting thing is here in aerospace, because aerospace itself is in a moment of turbulence across the world. Supply chains are really hit, and there are, it's almost like a flight to quality where the major OEMs are seeking to give their best suppliers more and more work share. And we are one of their best suppliers, so we're in a good place.
Thanks for tuning into Talking Point. I'm your host, Niraj Shah. And just before we get to our guest for the day today, it's important to highlight the two new kids on the block, simply because of the kind of response that they'd gotten to their IPOs and the resultant listing price that is anticipated. Remember, the premium that has been the discovered price is northwards of 100% for Unicommerce. For First Cry as well, or Brainbees, it's about 30-40%, which is not chump change. So it's not bad. You have to take it on board. But yes, I mean, Unicommerce would be something that will take the cake. And remember, Ola Electric has set the trend of companies getting, the recent listings actually seeing a lot of fanfare. It's 10 a.m. and therefore, let's get the rates up on the screen. Of course, the promoters of both the firms are happy people 47% uptick for Brainbees or First Cry, 127% uptick for Unicommerce. And actually, I must say, post the discovered price, it's Brainbees which is actually revving up even more relative to its issue price. But not a bad listing, by the way. 50% is great bang for the buck, just that it's dwarfed by the 168 times subscription that Unicommerce got and the subsequent uptick that we're seeing in the stock. So good move for this one at the start. Let's see how this does during the course of the day, but strong listings for sure. And frankly, viewers, that's my opening piece to our guest today, Pramod Gubbi of Marcellus Investment Managers. He joins in on the show after a long time, is about the kind of shrugging off that the Indian markets are doing around most things which would typically be considered high beta. New listings are getting subscribed well, listing well. A Hindenburg note which really brought a lot of volatility in 2023 has been shrugged off quite vehemently by the markets yesterday. And typically, Pramod, when global markets used to move 5%, Indian markets used to move 7-8% in the past, right? We've now suddenly become a low beta market. So what's happening? Is it domestic flows or is it something else? Good morning and great to have you.
Good morning. Always a pleasure. Thanks for having me, Niraj. It's that stage of the market cycle, right, where people throw caution to the wind. There's no concept of risk really, and particularly reflective of the heavily retail-oriented flow nature of the market. But there's hardly any regard for earnings. I can understand some of these macro events have been sort of misleading, but at least the earnings season should have meant something in terms of having some semblance of reflection of stock prices to earnings. That hasn't been the case either. And it's not the case in India itself, right? We've had geopolitics situation play out globally for the last couple of years, and markets across the world have only gone up. We've had the scare last Monday in Japan, and yet we seem to have forgotten all about it. And not just in India, across the world as well. Even the S&P has made a comeback. So it's a very peculiar phase of the market where absolutely nothing bothers. In India, at least, we can understand because this is largely retail-driven. Flows beget flows, which in turn push stock prices, which attract further flows. So we're in that self-fulfilling stage of the market. We've seen this in the past. This is not the first time. We know how that turns. It doesn't take much for it to turn the other way. But the challenge is in terms of knowing what will drive that turn. We've had a lot of events, like you pointed. Nothing seems to matter. But at some stage, I guess this will end.
Yeah, but Pramod, just wondering if because we were doing the statistics, right? It's not just in the Indian market. We're seeing this play out global market too, right? I was seeing this statistic about how Amazon's AWS revenue of the last 12 months was higher than the revenue of maybe another 400, 500 companies. Or if you look at what Apple has done, right? P ratio has moved from 10 to 30. It's not that the growth in business has been that great, that strong. So valuations across markets, etc., have all moved up. What could bring this down? Because we are now staring at a Fed rate cut cycle. The past 4 years have shown that any such instances turned out to be net positive for equity markets by and large.
Yeah, that's the $1 million question. I don't think all we know is corrections are a feature of the stock market, but very rarely do we know what drives that correction. And like they say, the biggest risks in the market are the ones that we can't foresee. So like I said, geopolitics has been a concern. There are wars happening across the world, yet the markets don't seem to be cognizant of that. We've had a little bit of a scare in terms of a market crash last week. We've taken that into this stride. We've had a fairly lackluster earnings season, mind you, so even that doesn't seem to bother the market. Financial crisis, possibly. I think that risks are rising in the US, something like commercial reality sort of resulting in a bank or two going belly up could be the trigger. More often than not, that has been the trigger because there's a contagion effect there. But we don't know. The risks on commercial real estate have been around for a while now. But yeah, I mean, it is a bit of a futile exercise to figure out what will drive. Better to focus on valuations to bottom up, make sense of earnings potential of companies, look at where valuations are, and accordingly build portfolios. And today, it's a very hard bargain across the market. I mean, the Nifty is a bit misleading in terms of its price to earnings ratio. The broader market is way, way more expensive. Median valuations are perhaps at all-time highs, even more than the peak of the 2007 rally. So, I mean, it is important rather than trying to second guess when the market will correct, because markets may sustain this momentum for longer. But better to work bottom up, get yourself earnings comfort, get yourself valuation comfort, and stay invested.
Got it. Okay, Pramod, the nature or the let's say the areas where the market is betting on have changed a bit, right? In that, and they always change, of course, but just that there is a wider universe available. If 2023 belonged to defense and railways, suddenly we're seeing a bit of a flurry for energy as a theme, and energy as a sector that is coming up. Where is it that Marcellus has the highest conviction, let's say, for example, within some of the non-heavyweight sectors? So I know you guys must be constructive in finance and financials, and those stocks have done well. It's, or IT, you might have a different view, but those are heavyweight sectors. What about the non-heavyweight sectors?
Well, I mean, we remain bottom-up investors. Our focus is more on factors. We would position ourselves on quality and growth. So therefore, a high ROC is fairly important. That itself rules out some of the sectors. Growth visibility hasn't been that great. Clearly, pockets of the economy are slowing. There are some green shoots in consumption, particularly rural consumption. But consumption is a sector which also has been derated consistently over the last few years. So you're right in terms of what they call as the regime change in the market. We had a very long period of a unidimensional market over the last decade, say the 2010s. It's only in the last 3 years we've had a broad basing of the economy, the broad basing of the market, where certain sectors like industrials, capital goods, thanks to, say, spending from defense, railways and all, have come back into the reckoning, both in terms of earnings growth as well as the valuation expansion. That, I guess, is running out of steam at this stage. Maybe some specific sectors with defense spending could sustain in terms of earnings growth. But I reckon you're right. There's been a shift in terms of the market attention. Consumption could be bottoming out. There could be interest coming in as even the government policies move towards boosting employment and hopefully consumption. We've had a reasonable monsoon. Inflation seems to be cooling off, at least the food inflation. So that should mean that rural consumption should pick up. So low ticket FMCG type of sectors could come back into growth. And like I said, valuations have been fairly reasonable. Financials, of course, yes, we all know, particularly the banking system has been struggling to raise deposits. It is a reflection of the state of the economy, the state of the markets we are in. We've had a high inflation, so the central bank has had to keep liquidity tight, but at the same time, a lot of the liquidity is flown into capital markets, which has deprived the banking system of deposits. So therefore, in some ways, the banks could become a hedge, because if we see a correction in the capital markets, maybe some of that money will flow back into deposits. If we see economy cooling off further, we could see the central bank getting more constructive in terms of liquidity easing. That would also help banks. And valuations are perhaps that's the only pocket in terms of large sector which continues to remain attractive. The other pockets, of course, we have some interest in capital goods and industrials where we have earnings visibility. I wouldn't say across the board as a sector, but you'll need to be more specific and bottom up. We do see some opportunities there. But more importantly, I think as we enter a very difficult phase in terms of earnings growth, the presence of comparative advantages becomes a big driver of earnings in a situation where all boats are lifted by the tide. It becomes more broad based. When the going gets tough, those strengths of balance sheet strength, comparative advantages come to the fore, and therefore it becomes great for bottom up investors and discerning investors to pick up stocks.
Right. Yeah. So, okay, point well taken. And maybe, viewers, sometimes a cautious approach at the times of frenzy really helps to protect downsides. But I tell you what is in a frenzy, and that's wind energy space. Look at the kind of moves that some of these businesses are making, or wind energy equipment manufacturers particularly. Mihika joins in because she interviewed Inox Wind yesterday. The stocks are on a tear. She tracks both Suzlon and Inox Wind very closely, amongst other things, energy. And Mihika, the valuations are stratospheric here. What's gone behind this kind of frenzy into these stocks?
Yes, the valuations, like you mentioned, like the current valuations for both Inox Wind and Suzlon Energy are trading around 104 and 105. This is an EV per EBITDA multiple. But when we did speak to, the management, when we see the kind of revenue potential that these companies have in terms of order book, these valuations could moderate for FY25. For Inox Wind from 104 to 37, and for Suzlon Energy it could be from 105 to 62. Now, why when we talk about that? Well, one is the macros are changing. Now, the wind energy did see sluggish capacity growth additions from FY17 to 24. However, various government initiatives have kind of built the traction. The government has removed the reverse auctions for plain vanilla winds. They've organized auctions for wind energy projects specifically. They've also introduced renewable purchase obligations that are targeted towards wind power. Even the market size of wind energy in FY25, we spoke to Inox Wind, and the management stated that for FY25 the entire domestic size could be of 5 gigawatts. For next year it could be 6 gigawatts, and from 27 onwards we could see a domestic market size of 8 to 10 gigawatts. As per Investec, the overall opportunity is at 13 to 14 gigawatts per year, and this is based on the government's target to add 10 gigawatts of wind capacity every year. We've also seen strong earnings and commentary from both the companies. Inox Wind in Q1 revenue and EBITDA was up 83 and 325% on a year-on-year basis. They posted a net profit of 50 crores versus a loss a year ago. The order book is 2.9 gigawatts, and it gives them a 2-year revenue visibility with a revenue potential of over 17,000 crores. Even with Suzlon Energy, revenue and EBITDA was up 50% and 78% year-on-year, and net profit was up 200%, and their current order book has also significantly grown to 3.8 gigawatts versus 2.9 gigawatts just last quarter.
Okay. Megha, thanks for putting that into perspective. Some bit of a cool off in Suzlon, but Inox Wind and Inox Wind Energy are seeing no such thing. Pramod, any thoughts on the ancillary businesses of power? These are large market caps now. In some sense, Suzlon is over 1 lakh crores of market cap. But any thoughts on whether this or power financiers or any of those others? I'm not just talking about the energy producers, but some of the ancillaries, because all of them have moved up the valuation chain.
No, it's very difficult to see. The valuations are suggesting that demand for power will go on till perpetuity. I know power is a crucial sector. It's not like we're a developed country with penetration of power. There is a long growth runway indeed. But today, whether it's for the power producers or the equipment makers for the power sector, valuations are simply not sustainable. In my view, at least, it's very hard to justify without taking very unrealistic expectations in terms of longevity of growth. So it's not a growth sector. At the end of the day, it is utility. Yes, there is under-penetration, but at this stage, we don't see any sort of place that... if you're a momentum investor, it's a different point. But if you want to do fundamental investing with some sense of intrinsic value, it's really hard to find that value.
Hard to find the value, but look at, the stocks are seeing no end, and the commentary is very constructive. But as Mihika said, the valuations for some of these have shot through the roof. Pay heed to the valuations. By the way, I'm no one to recommend anything, but yeah, brokerages seem constructive even now at these EV EBITDA valuations. Maybe the future growth look okay for some of these. What we do is take a break. On the words of fine caution from Pramod Guppi, we take a break, continue our conversation with him on the other side. Stay tuned. All right, back with Talking Point in conversation with Pramod Guppi, and we were talking about stratospheric valuations. Pramod, the new kids on the block are getting subscribed very, very strongly. They are listing with good premiums. We've seen that happening with Ola. We've seen that with the two companies today as well, including Unicommerce, and a fairly diverse range of companies coming in as well. It's not just an auto ancillary. It is not just a pharma company. These are differentiated models. What do you think of the newer spate of listings that have happened? Because it's been very varied. Anything that has stood out for you guys at Marcellus?
Not really. I think at this stage of the market cycle, we would rather be prudent in terms of looking for businesses which we understand really well and have gone through cycles. Not to say anything about the new listings, but for exactly these reasons, right? So the sort of demand for these IPOs doesn't allow us to take a more nuanced view. But that's the nature of these rallies. IPOs tend to benefit. But more from a structural perspective for the market structure, I think this is a great deal. The sort of businesses that we are coming into the listed space are becoming a lot more diverse. It's great to be managing funds or be a research analyst in these markets. And also from demand supply perspective, it's great for more and more paper, more and more equities to be available, given the sort of structural increase in financial market participation that we're seeing from Indian investors and Indian households. So we will need more and more businesses. So it is a great deal from that perspective. But it's very hard in these markets, looking at the screen now, these sorts of movements. It is a reflection of the frenzy that you talked about. And we tend to stay away from that.
Okay. Well, there's frenzy, all right, because I just want to invoke one small conversation with my analyst, Puneet, because we were talking about new companies, and Pramod's advice is well taken, but, investors in Ola Electric seem to be really warming up to that stock, because post-listing too, that stock has had a good run. Puneet, what's happening here with Ola?
Well, definitely, the valuation now crossing roughly $6 billion, market cap over 50,000 crores. And definitely, the valuation was brought down in this particular IPO from 5.4 billion when it was a private company, the last raise, to $4 billion. Since then, it has just crossed that limit in the last 2 days. We saw 20% upper circuit in the last 2 days, and now again 10% upper circuit today, and it's trading right now as well. The key thing to note here is, it's going to be an action-packed week tomorrow also, because the company is scheduled to release its Q1 results tomorrow. On 15th, it's scheduled to launch its first ever electric vehicle bike as well. So the action will continue for Ola Electric specifically. But just to highlight, the valuation perspective right now, it's a loss-making company, about 1,500 odd crores, so can't do price to earnings. But its EV to sales, if we just take in FY24 numbers, is trading at roughly about 9 times now based on the current price. When you compare that to someone like a TVS is trades at about 4 times, while Bajaj is at 6 times. So definitely gone above the premium scale. We did speak about the benefits of the company in general, with battery head coming from LG Electronics, their 35% market share. But the strong response post the tepid listing is something to watch out for. And these events for the next couple of days will be a key to look out for as well. What looks out for the commentary as well going forward in Q2 and Q3. Back to you.
Okay, thanks a lot for that. Pramod, if not newer listings, then mobility, auto, is there something that is looking interesting here? Because that too has got a variety of things coming in, including battery storage, electric mobility, all the new facets coming in. What are your thoughts here?
Yeah, I'm sure there is a structural change in the whole setup, whether it's electrification or autonomous. The automobile industry globally is going through structural changes, which allows for opportunities to come in terms of incumbents usually suffering from innovators' dilemma. You'll see new entrants making a grab for the market share and growing faster than the industry. Having said that, we have been more watchful. We're quite happy to let these initial sort of disruptions play out because we tend to be longer term investors. We would like to see longevity and performance across cycles. That also comes with its attendant risks that we might miss out on very attractive valuations very early on. This is a market that's unlikely to be the case. We will hope for better entry points there. We've been very limited in terms of exposure to auto. We own iShare, which has exposure to high-end motorcycles and trucks through the joint venture with Volvo, where we find there is an opportunity for growth to justify the valuations. We like a lot of other businesses, but valuations have been hard to justify. So we will wait for better entry points across the automobile space.
Okay. We might. I think Finance Minister is speaking, and we'll probably cut across there. But just before we do that, Pramod, the financials, because you guys have such a deep research out there. You ran a Kings of Capital portfolio, probably still do. Just trying to understand. We are at the cusp of a Fed rate cut cycle, if you will. Maybe inflation drops in India further, and maybe even RBI does something. Independent of that, or because of that, or otherwise, are financials within a bucket that you like? And would you invest in anything, for lending or non-lending financials?
Yeah, I mean, the lending financials is where we find valuation comfort, particularly the banks. And we know the reasons. They've been out of favor because margins have been on the decline. In some pockets, even asset quality deterioration is sort of rearing its head. But given the valuation comfort, and like I said, any sort of cooling off of the economy resulting in loosening of monetary policy, loosening of liquidity could revive deposit growth, which in turn should help the margins. Now, what will drive that? Like you said, it could be the Fed rate cut, cooling off of inflation. And like I said, even a cooling off in the capital markets could release some liquidity into the banking system. So that remains a key area of comfort, at least from a valuation perspective. The non-lending financials have done really well. We've benefited from a lot of exposure either to the insurance plays or even the capital marketplace. That's where I would be a little more cautious, given that these look like peak earnings and peak multiples. Any sort of risks on the capital market, you could get a double whammy on the downside. So again, going back to valuations, we would rather prefer the banks, which have sort of struggled from a deposit growth, and that's kept valuations attractive. And deposits are cyclical. We know at some stage they'll come back, and we should see the benefits of that coming through.
Okay. Pramod, last question. Do you sense any slowdown in government focus on capex, railways, roads, other things post-budget, or do you reckon that it continues as was announced in the Feb budget?
Very early days yet, given monsoons, these things tend to slow down seasonally, but we'll just go by what the government has put out in terms of numbers, and full credit to the government to have done the balance on the budget through capex growth, at least the budgeted numbers remaining as it is, and yet finding some amount of money to boost employment and therefore consumption. I think the RBI special dividend of sorts helped do that, but I think it's very early days to figure out if there's any slowdown on the capex front.
Okay. Well, Pramod, hopefully the frenzy doesn't end in a whimper. Even if there is a correction, let's hope it's a bit more gradual and calmer. The Indian markets have turned low beta. Let's hope it stays that way. But thank you so much for all the insights today on Talking Point.
Pleasure is all mine. Thank you. Thanks for having me.
No, the pleasure was ours. The Bank Nifty is the culprit today, by the way, down about 0.5%. HDFC Bank leading the charge. Else, the markets might well have been in fine fettle because IT literally is masking up for all the losses that the Nifty Bank has put out in the session. Thanks so much for tuning in to this edition of the Talking Point. It's a wrap.
Hello and welcome. This is the F&O show. I am Agam Vakil, and in this show we take you through all that's happening in the futures and options space in Indian equities. But first, a look at the markets, which are currently quiet at the moment, and there's been a little bit of pressure which has settled in over the course of the last 20 odd minutes. We are looking at the indices trading near day's lows, and the Nifty, of course, has moved below the mark of 24,300. Today is a day of the weekly Fin Nifty options expiry as well, and it is under pressure. In fact, that one is down as much as 9%. But we must remember that about a third of the weightage on that index is on account of HDFC Bank. HDFC Bank, as we all know, is the one responsible for pulling the banking indices down, as along with the Nifty 50 as well. Now, HDFC Bank is down around 2.8%, and that's also largely led to a lot of weakness in the key indices across. But besides that, let's take a look at the contribution of the Nifty 50 and see what else is pulling and tugging at. Actually, it's nothing but HDFC, which in fact provides for the 80%, or pardon me, 80-point loss out of the 120 points that we are looking at in terms of declines. And while we do have marginal advances for Bharti, TCS, Axis Bank, SBI, etc., it's just a marginal gain contribution. So overall, that's the reason why we are seeing about a 70-odd point decline on a net basis. But let's move on and talk about the broader markets. There is certainly outperformance there when it comes to the mid-cap indexes of small-cap indices. In fact, both of them are... Whoa, actually, I take that back. We are now looking at the mid-cap index, which has moved into the red. Is that the case for the small-cap index as well? Let's see. Yes, it is. And in fact, we are seeing a 0.2% decline for the small-cap 250 index as well. So there's certainly a lot of concerns here that we are keeping an eye on as far as the markets are concerned. Some pressure building in, even in terms of stocks which did start out of the day with a lot of strength and eventually are being sold into. Let's take a look at the futures and options space now and see whether or not there are shorts being added into the key indices. So we have open interest increase of around 2%, even as the Nifty declines by 0.25%, and that's where we are certainly seeing a little bit of short play coming through. What about the Bank Nifty futures? Let's pull that up as well, and we do have the same here. About 5% added in OI for the August Bank Nifty futures too. Well, the spot has lost out on 50,500, and now we are watching out for 50,500 on the futures as well. Moving on, let's keep an eye on the options market as well. And, as I've been mentioning over the past few days, while 24,000 is the one which has substantial amount of puts, today is a day where we are seeing further writing around the 24,200 and 24,300 levels as well. And of course, on the higher end, we continue to keep an eye on 24,400, where there is a substantial amount of writing as far as calls are concerned. Well, that's as far as your option market goes. But let's bring in our experts for today. We have Kush Bora of kushbora.com and Sneha Seth of Angel One, who's joining us on the show. Good morning to both of you. Thank you so much for joining in. Kush, I start with you. Your view on the Nifty 50 specifically. I guess it's mostly because of HDFC Bank is the reason why we're seeing pressure here. How are you reading cues on this particular index?
Hey, hi Agam. First of all, very good afternoon to you. And I must say, it looks like it's been a very long day for you, and it's barely half done, right? So, yeah, all the best for the rest of it. Yeah. Well, as far as the indices go, I think what we've maintained, that view is sort of coming to play, which is the bias could remain positive because the kind of buying on dips that we've seen recently. But I think any kind of fresh momentum should be expected on Nifty and actually on Bank Nifty also once the key levels are taken out. And that level happens to be 25,000 for the Nifty, where you've got the 20-day moving average coinciding. You had a lot of call base also, a very heavy call base kicking in. So I think once that level is taken out, will you see any kind of fresh momentum? But at the moment, the way you've seen the market rebound from the last week lows, it's certainly a buy on dips kind of a market. Also, if you see 24,300, for the current expiry, current weekly expiry, which is tomorrow, has a very strong base. So, it'll take some effort for that level to be broken out, at least in a more, meaningful way. So, I'll be a little optimistic here. Buy on dips. You may not get a runaway rally on the Nifty just yet, but, with tight stop losses and, let's say smaller target, you could consider a buy on dips kind of a strategy on the Nifty.
Okay, so buy and dip strategy on the Nifty. Sneha, morning to you as well. How will you trade the Nifty at the moment?
I would avoid trading the Nifty at this point in time. If you see, it has been consolidating. At present, I believe 24,000, 24,100 has been acting as a support. The support has been shifted up. And on the higher side, any move at least beyond 450, 500 would be important to watch out. Otherwise, there are chances that we may continue to consolidate. So any move beyond this range, then only we would go ahead and take a directional bet. Otherwise, it's better to avoid any aggressive trades and indices and focus on individual counts.
Okay, so avoid trade on the Nifty. Sneha, would your assessment on the Bank Nifty be the same, or is there a decipherable trend at the moment here?
No, for banking index as well, I believe 50,500 to 50,800 is the resistance zone. So any move beyond that, that would be, a point wherein I would suggest going long. At this point in time, there are more chances that we may consolidate. On the lower side, I believe there is a support around 49,700, 800 zone. So this is the range for banking index as well.
Okay, that's the range for the Bank Nifty. Well, Kush, your assessment on the Bank Nifty as well. How would you play this?
So, Agam, there was a brief moment where Bank Nifty was showing strength, the last couple of sessions, where it looked like it could be taking on the mantle from the IT space and perhaps leading the charge, on the next rally. I'm not saying that entirely fizzled out. The move on HDFC Bank today is on account of news. Once that is digested, perhaps it'll take it in its stride and continue to move higher. But here too, a little watchful. As Neha already said, I too concur with the fact that 49,700, 49,800 is the zone. As long as that is maintained, and if you have a long position, with those kind of stop losses, you can continue to hold your long position. On the upside, my view also remains the same, which is 51,000 thereabouts is the key level to watch for. Any kind of momentum should be expected beyond that. But even Bank Nifty for now has displayed, a buy on dips kind of a strength, albeit a little weaker than the Nifty. So I'll be a little watchful. Buy on dips continues, but again with very strict stop losses and maybe play for smaller targets.
But Kush, I'll take up the factor of HDFC Bank weighing down on the key indices, right? Because over the past few days, and I would perhaps consider the past 2 weeks specifically, we've seen it make a bottom of somewhere around 1519 thereabout, and of course a high of a little over 1660, 1670. My question is that, does today's turn actually change things, or would you want to wait for a change in, or perhaps move beyond these levels to decipher a trend on HDFC Bank?
A very interesting question, Agam. Very well pointed out. Look, news aside, if I look at it purely from a technical standpoint, you're right that 1590 kind of zones have been a very strong base. In fact, the reason that the Bank Nifty was seen to be taking charge for the last couple of sessions was the rebound that we saw on HDFC Bank from 1590 to about the 1670, 1680 levels. Even now, I am not as pessimistic, or I don't think the HDFC Bank stock per se has a lot of room beyond the 1590 move. The base is pretty strong. As long as that is respected, as I said, the news that we've seen today could perhaps be digested, taken in the stride, and the stock could then perhaps start move higher. Now, does it really give you that breakaway rally? Not sure entirely, because the 1700, 1720 resistance has been a strong one. So like for Bank Nifty, 51, 200 remains a resistance to cross for momentums to come in. 1700, 1720 are the levels to watch for. But if I were to pick a trade, I would actually go on the long side for HDFC Bank with 1590, or 1580 thereabouts being my stop loss, and taking a more positional bet.
And I want to just juxtapose that to and with Axis Bank and ICICI Bank. So maybe I can take both these counters up with Sneha. Let me reiterate what's happening with both these counters. So they're clearly against the grain, because while HDFC is declining by as much, and it's of course based on news, we are seeing both Axis Bank and ICICI Bank maintain being in the green, staying in the green for now. But they both have also been largely range bound over the course of the last 2 to 3, or in fact, I would say 6 to 7 sessions as well. Sneha, your view on either of these counters, ICICI or Axis Bank?
Agam, if you look at the chart structure, both the counters are near the support zone. However, if you look at the overall view, what I have is that there are chances of consolidation. Any move in banking index, especially above that resistance zone of 50,800, 51,000, that only will, trigger some momentum in these counters as well. Otherwise, if you see one of the day there is a buying in HDFC, another day if there is a selling in HDFC, we are seeing the index being supported with maybe ICICI or Axis Bank. So there is index balancing which is going on at this point in time. So I would avoid any fresh trade in these both counters at this point in time.
Okay, so avoid a fresh trade, but as Sneha suggests that both these are near support zones. And, we've already spoken about the kind of little bit of a dichotomy that's playing out between HDFC Bank and Axis Bank and ICICI Bank. But with that, we also take a look at all the stocks which are in fact buzzing in trade. I'm going to start as usual by taking a look at stocks which are seeing an increase in open interest to see whether or not there is something on the go. Now, we do have Aarti Industries, which is looking at a deep cut, down 13.5%. The management has suggested that, or rather, actually, the management has not suggested. They are, of course, expecting a better second half. But there has been, some concerns with respect to their guidance going in, and which is why we're looking at a whopping 21% increase in open interest towards what looks like shorts as far as Aarti Industry goes. Then we have something like a GNFC, which is also wilting under marginal pressure. It's the same for NMDC, by the way. And NMDC actually came up with reasonably good numbers too. But longs for Apollo Hospitals, that's up 1.5% right now. So we have some longs building in there. What about stocks which are seeing unwinding? Let's pull that list up as well and see where there is traction. So a lot of long unwinding, in fact, for Sun TV, Siemens, Canfin Homes, Glenmark Pharma. Mind you that Sun TV was down yesterday as well. Yesterday it was looking at a sharp increase in open interest. Today it does seem like some of your shorts may have been covered, but the stock is still under pressure. So I do not want to classify it as short covering, because it does seem like there's more traction towards the downside. So it's going to be a questionable counter, at least in the near term, when it comes to strength returning to this one. But with that, I will move across to our experts to tell us about stocks which are on their radar. Sneha, first up for you, what's looking good to you?
In individual counters, I guess this Hero MotoCorp looks good to me. If you see, this counter was consolidating, and recently it has been taking support near the 89 EMA. From last 2 sessions, we are seeing some buying interest coming in. So I would recommend buying an options over here, going ahead and buying 5,500 call option in the range of 510. The stop loss can be maintained around 70, and the target expected will be around 187. Apart from this, again, HUL looks good. This counter has been maintaining, strength recently, and I think it looks poised for a follow-up move beyond these consolidation. What we are seeing, any momentum above 2007, 80, 85 would be interesting to watch out over here. But looking at the overall chart structure, it looks strong, and I believe we can go ahead and long at this point in time as well. So with a strict stop loss of 2007-17, it's a buy, and the target expected will be around 2008-20.
Quick reminder to our viewers when it comes to Hero MotoCorp that they will be announcing earnings today, and Sneha's idea of buying a call would actually play out very, very favorably if things do go in favor of Hero MotoCorp with respect to earnings. And because Sneha is suggesting buying a call option of 5,500, and we could potentially, there's a potential chance that if the earnings are good, if the earnings actually beat expectations, then there could be an elliptical rise in the price of that particular option. So always, a good idea, because that way you won't have too much of time decay, which may play against, considering it's a relatively short-term move. And let's not forget, the SNEA has also given us a stop loss on that particular option at around 70 odd, in terms of premium. But Kush, coming back to you, stocks on your radar this morning?
Sure, Agam. Given the texture of the market, we've got a long and a short strategy. Lupin, this stock's been gaining a lot of strength. There isn't anything suggesting that, this could perhaps, end anytime soon. Maybe around a profit booking here or there, but I think overall structure for Lupin is pretty strong. So I think from a near-term perspective, you could look at 2165, 2190 as your targets. Your stop loss could be just a little under 21.